This episode is brought to you by Koifin. Koifin is one of the fastest growing platforms for financial data and analytics to research stocks and understand market trends. Imagine a Bloomberg Lite with tons of high quality equity and macro data, a powerful graph engine that can show it all clearly, and a user interface that doesn't look like it was built in the 1990s. If you're an individual investor, research analyst, portfolio manager, or financial advisor, do yourself a favor and check them out. You won't regret it. Sign up for free at koifin.com. That's KOYFIN.com.
Hit it. It's Friday, October 22nd, 2021, episode 153. I'm Patrick Ceresna.
And I'm Kevin Muir. This week, we welcome to the show stock market wizard Mike Masters. We have a fascinating discussion with this hedge fund veteran that you won't want to miss. Mike is one of my favorite people to discuss markets with, and it's a real privilege to have him on our show. Then we get caught up from 2 weeks away with Patrick's Talking Charge segment.
This week in trading history, we go back to the panic of 1857, and we end with the segments of No Stupid Questions and Skin in the Game. And folks, we might even drink some beers along the way, so stick around. We got a great show. Lena, hop on. What beer are we drinking this week?
Today we're drinking Stack Brewing Company's Pupper's Golden Lager, the official beer of Letterkenny.
I am so excited about this. As you know, I am a huge fan of Letterkenny. I think it's one of the greatest shows. Like when you put aside all the juvenile humor, the other part of the humor is awesome. And little did I realize that they had their own beer, so we went out and got some. And I hope it's as good as the show.
I gotta read you this little blurb here.
Okay, go for it.
Puppers is a premium light lager that is perfect for lawn mowing, hand sawing, super soft birthday party throwing, trash talking, glove tossing, knuckle dusting, and rabble rousing. You don't need to be the toughest guy in Letterkenny to enjoy a few puppers. To be fair, you don't even need to be a guy to enjoy this easy drinking golden lager. Hell, you could even buy 10-ply. But have a few puppers and you might find yourself in a Donnybrook like old Wayne. For all you Letterkenny peasants, the lager itself is good for all day drinking, whether that's after some early morning yard work or it's dousing your liver during an NHL best of 7. It is also a great beer for waterfall style drinking games.
Nice. That's what I appreciate about you, Lena.
All right, let's get to our interview with Mike Masters.
Not before we do the side effects and the disclaimer, Patrick.
So shit.
Nothing in this podcast should be viewed as investment advice. Listeners should consult an investment professional before making any decisions regarding topics mentioned in the show. Side effects of too much huddle may include real rate rash, manic inflationism, and fiscal dominance disorder. Okay, now on to the interview with Mike. It's my pleasure to welcome to the show Mike Masters. Mike, a lot of people have always have been nice enough to jump at the chance to be on the Huddle, but you are one of the few that has insisted on coming up to Toronto to do it.
That's right.
So thank you for being on the show, and thank you for coming up.
Yep, happy to be here, and I'm sort of tired of the virtual world, so I'm happy to travel a little bit and do this, and plus you can hang out and have dinner and stuff afterwards.
That's right. So I've been looking forward to this for numerous reasons. I've had the pleasure of chatting with you over the last couple of years and getting to know you a little bit. But not only are you a great hedge fund manager, but you're also a terrific guy. And before we start, I just wanted to pass a story along that I got from your trader, Grady. And I don't know if I'm going to get Grady in trouble for this, but Grady was telling me what a terrific boss you were. And he says, not only is he smart as anything, a terrific guy to work for, but he's humble and he's also very, very down to earth. And he said, this is how down to earth he is. There was a sandwich that was left in the fridge. And he told me that the sandwich was left in the fridge and it was there a couple of days and you were worried nobody was going to eat it. So you decided to eat it. Is this true?
That's true. Yeah. I like to eat, and I eat a lot of food, and that's why I have to work out. But yes, I like to, look, I mean, we've got a good organization. Grady's does a great job for us, and we've got a great sort of organization overall. Everybody sort of gets along.
Right.
And I don't know, I just sort of expect everybody to do what they do. And, by and large, it works pretty well. So I'm not a huge high pressure guy or anything.
Right. Yeah. Okay, so let's jump into, for people to get to know you a little bit better. Why don't you tell us where you grew up, how you got into this business?
So I was born in Dallas, in Texas, and lived there a couple of years. And so I'm a Texan. I'm actually a fourth generation Texan. And if you're from Texas, that's important to state, because people from Texas, if you're from Texas, that's a really big deal. And so I always state that. And my dad sort of drilled that into me. And so even though I only lived in Texas a few years, I always say that I was born in Texas.
Okay.
It's important. So, and then I moved when I was young to Chicago. I lived in Chicago, up a suburb called Northbrook, just north of the city. Lived there for 6 years, and then moved back south to Atlanta. Lived there through high school. I went to college at University of Tennessee, where I was a swimmer. Graduated from there and started work with a little sell-side shop, J.C. Bradford,
Okay.
who was later bought by Payne Weber, who was bought by UBS. So it was a little New York Stock Exchange firm based in Nashville. And so I was a salesman there, and then I worked for Oppenheimer as a salesman, and then I started my firm in 1994, and then capitalized in 95.
Okay, so one of the parts that you missed is the fact that you went to school and you were a swimmer.
Yes.
You look like Michael Phelps.
Well, swimmers, today swimmers are big, and even back in the 90s, or in the 80s, I should say, when I swam, they were big. And I was a sprinter, so sprint freestylers are sort of bigger than normal swimmers. So, I was a swimmer and went to the Olympic trials. Unfortunately, I got the mumps the year before, and so I wasn't.
What year would that have been?
So that was 88.
Okay.
So, yeah.
In LA. Was that LA?
No, that was 84. It was Seoul, Korea.
Seoul. Okay.
Yeah, Seoul.
But so you were on track to make it, and then you got the mumps.
The year before I got the mumps, and I just wasn't really the same. So I was, and this, talk about vaccinations. So I had a vaccination that didn't work.
Oh.
The vaccination for everybody that was born at Baylor University Hospital, and it's in Highland Park in Dallas. That vaccination, that like people in May of 1966 that were born there did not get a good vaccination. And so many of us got the mumps as adults or young adults.
You're kidding. So it was a bad batch.
It was a bad batch. So vaccinations matter. So
wow, I had no idea.
Yes.
We actually have a story here in Canada. We when the polio came and there was a bad batch. I don't know if you remember, will have heard the story, but there was a bad batch, and I believe the United States stopped it. They stopped giving it out as they tried to figure out whether the vaccination, there was something wrong with it or what. And the Canadian guy said, forget it, we're going to keep pushing through. We think it's just a bad batch. And he took a huge risk, and it ended up being the right call. But it was super scary because at the time people are getting sick, and you're thinking maybe it doesn't work as well.
Yeah.
It's actually it's a fascinating story, though, that you have a whole section of people that got sick. How did you find that out? Like, did they contact you after the fact?
So I met people, and we sort of like from Dallas that were born in the hospital like throughout my life. And they're like, did you get the mumps? And I was like, yeah, I got the mumps, right? And so we figured it out. And somebody at some point had done some work and said, hey, we all got a bad batch.
Wow. So you gave away the 1966. That makes you the first year of the millennials?
Yes.
How does that feel?
Well, of Generation X.
Oh, sorry. Generation X. I got it right. You're absolutely right. Yeah. So how does that feel to be the first Gen X?
Oh, it's good. It's I like Gen X. Gen X is a great generation. We're we haven't caused any problems.
I know. So I have a theory that we're never going to get a president. They're going to just skip us. They're going to go straight from the boomers to the millennials.
Maybe. Maybe. I don't know. We've got, but we have, look, I mean, it's, we've got good music. I mean, we get along with everybody.
That's true.
It's
That is true. Okay, so why don't you tell me, you go out of school and you start at this brokerage firm, and at this point you're, on the way to becoming like a regular stockbroker? Was that your goal? Like, had you given this any thought?
I didn't. Well, I just got in the business. I had a degree in finance, and I started out in pre-med and figured out after a couple of years that I needed to be in finance instead of pre-med, and so I switched. And so I as an athlete too, it's weird, because when you're an athlete at an SEC school, what their number one concern is to make you eligible. Like they don't really care what you take. They just want you to be eligible.
Eligible to swim, you mean, or to
eligible
perform?
to perform, to be
Yes,
an
that's
athlete.
right. Okay, yeah.
Right. So they're number one, they're focused on your eligibility. I mean, your academic stuff is fine, but they want you to be eligible.
Okay.
And so I took a lot of stuff, you know, sort of weird courses.
Bird courses.
Yeah, sort of like crazy courses that were like not really necessarily appropriate to pre-med either.
Okay.
You know, starting out because, you know, the athletic department sort of picks your courses. They're like, well, you're going to take this and that and whatnot.
They want to make sure. And I guess at the same time, you're also spending all the time in the pool.
You were, yeah, I was, yeah, exactly, yeah. And they don't know. I mean, you know, generally swimmers did a little better academically than some of the other athletes, but they it didn't matter. They treated everybody the same. Okay. So anyway, so I was in pre-med. I switched to finance, and I finished college, and I didn't have a job lined up. And I remember I talked to my dad, and he was like, "Well, you know, I've traded, and my Uncle Louis traded, and my Uncle Larry traded, and he's like, you know, why don't you get a job as a broker?"
Okay.
And I'm like, yeah, that sounds good. I was like, well, who do you know? And he's like, well, just get the phone book out and call some people. And so that's what I did. So, I mean, like I started at the bottom, like the bottom. So fortunately, a guy that lives in our neighborhood was a branch manager for J.C. Bradford. And he had seen me on the weekends mowing lawns, like cutting my lawn and cutting my neighbor's lawn and cutting Miss Patton's lawn, who was around the corner from us. And so that was... I guess he thought because I mowed lawns every weekend, I was industrious and whatever. And I was a hard worker. And he said, I'll give you a shot. So he said, usually we need salespeople and they need this and that, whatever. And he said, well, I'll give you a shot. So I got in the business, and I did not, you know, I think it's sort of a sink or swim business, as you're probably aware. I mean, it's not, and it's really not about making money so much as it's about, you know, selling.
Right.
Right. And so, you know, especially at that level. And so I figured out pretty quick that I didn't really want to do it for forever, but I thought it was a good, you know, I didn't really have a choice. I had to start somewhere, and it was a good place to start.
Okay. So you come in there and you start as a broker, and now you don't really have any, like, you have schooling, but you don't really know anything about the markets, I'm assuming, and this is all new to you. What was that like?
Well, I knew a little bit about it because my father had traded and my Uncle Louis had traded and my Uncle Larry had traded. And so I listened to them at family gatherings.
Oh, so when you were at events, you would hear them talking about it. Like they traded enough that
every single event I went to. And I was the only male in the family. And for whatever reason, you know, this is the 70s, you know, they stuck me in like the middle of the couch where they would be talking about stuff. And I, you know, even if it was just osmosis, I was just sitting there listening to all this, you know, I bought this and I sold this and I shorted this. And my dad traditionally he did more on the short side. Oh. My Uncle Louis did more. He was more of a sort of I guess, a traditional long-only investor.
Okay.
So
your dad, that's unusual for back then, that there was someone who worked on the short side. Yeah. What attracted him to the short side? Like, what was this? You know,
I don't really know what attracted it to him. He seemed to do pretty well at it. And, you know, he was, you know,
maybe it's a function of being in the market from 1970, 5 to 82.
Yeah, when you think about, 70 to 80, I mean, those weren't exactly great periods in the market. I mean, it was a really tough decade. Like, you know, so. And a lot of stuff went down a lot during that period of time.
Okay, so you're there, you become a broker, and at what point do you realize that you want more than just being a broker?
Well, I mean, it was pretty clear that the brokerage, the sell side, especially in the retail huddle, if you wanted to sort of make money for your clients, there was a lot of conflicts of interest. I mean, you know, they wanted you to, you know, look, I mean, J.C. Bradford was a pretty good firm. It was a member of the New York Stock Exchange and all that, but they still wanted you to push their stocks or their products or whatnot. And I felt like, you know, I felt like the commissions were too high. This is back in those days, commissions were, you know, pretty high. I don't remember. They were full service. You know, it was different. It was a different world.
Yeah.
And so I remember at one point I just unilaterally cut commissions for all my clients. Oh. You know, and that was not popular from the home office. But I did it anyway because I was like, look, if you cut their commissions, they can trade more and they have more of a chance of making money and all that. So, but I figured out pretty quickly, I don't know, within less than a year that I wanted to do something else.
Okay.
So,
and so what was the next step?
Well, I think the next step was really just, you know, my dad used to have this saying that you know, most entrepreneurs, you know, at one point in their lives are fired, right? They generally are fired. And I think word got out that I was looking at Oppenheimer and so they weren't happy about that. And so, you know, they fired me, and then Oppenheimer didn't like, you know, I was a bit of a maverick, I guess, in terms of the way I operated there. And I mean, I wasn't doing anything wrong, but I mean, it just, I didn't really fit into the brokerage, the sell side brokerage and the retail side. You know, I always wanted to do, I was always sort of pushing the envelope to do different things. And so I was fired from there. And so I was like, well, I don't really want to go back to the retail. I mean, I could have, but I didn't really want to go back to it. So I decided I'm gonna, you know, create a fund that has, I'm going to set up the prospectus, and it's going to be my rules, and it's going to be fair to the investor, and it's going to be fair to me, and it's going to be above board. Everybody's going to know what the deal is, and we're just going to start off. And at that time, I didn't even have when I first set up, I didn't even have a management fee. I said, I'm going to pay for everything up front, and it's just going to be pure incentive, pure profit for the manager.
And may I ask, did you have a family at this point?
I didn't.
Oh, no, you didn't. You were on your own.
I was on my own.
Oh, okay.
Yeah, I was single.
Okay.
So, and it would have been hard to do with a family.
Right. Okay.
Right. So, because that's a real risk.
For sure. Yeah.
But I felt like it was very clean, and I felt like I didn't have a track record, so I didn't really have the right to say to people, hey, you know, I'm going to manage your money and charge you a fee without, you know.
Okay.
You know.
And at that time, did you make it, when you're first starting off, was it open-ended in terms of what you were allowed to do? Was it broad? And
so I set it up pretty, I mean, you know, look, you can set it up however you want to set it up. So
right.
I set it up in a matter of where it was U.S. equities, just listed equities and listed options. But it was primarily, my primary focus was just U.S. equities.
Right.
And I worked on it for a while. There was a guy named Ced Moses who had set up this sort of system where he looked at all these different things. It was actually a Barron's article written about him years ago. This is in the early 90s. And I don't even know what happened to Ced. I've never even met Ced. But anyway, I read this article.
Yeah.
And I thought, that's the way to do it, you know?
What was the crux of the article?
The crux of the article was basically, you've got all these variables, put them all together in sort of a stew, and you're going to come out with an investment approach, right?
Okay.
So I thought, well, that's good. I'll look at everything, you know, everything from the fundamentals of the company, from valuation analysis to all that, you know, technical analysis, and then also the macro environment, you know. What's the Fed doing, you know, political economy, all that stuff. And I said, I'm going to put all this stuff together, and then I'm going to put it together with a catalyst, something, a trigger to get me involved in the stock.
And do you think at the time less people were doing that?
Oh, yeah, for sure, less people. In terms of catalyst?
Yeah, or even just about putting them all together and putting it as a stew.
Yeah.
Like where people traditionally fundamentalists were fundamentalists and the technical guys were technical guys, and they didn't overlap. You didn't get someone who did both?
Yeah, I think it was probably, I think what Ced was doing was pretty novel. And I thought, you know, you could figure it out. And so effectively, so what happened is I tried to do that. I tried to replicate that. And I did it on Lotus, on spreadsheet. You remember Lotus?
Yeah.
Nobody remembers
For those who
Lotus.
don't know, the non-Gen X, it's basically the first Excel.
Right, exactly. And I, you know, fast forward 20 years later, I actually met Mitch Kapor, who is the founder of Lotus. Okay. 20 years later, and I'm sitting in his office, and I was like, Mitch, you know, I want you to know your spreadsheet helped me get going. Like it's put me in business. Right. And he's like, you know, thank you for saying that. And so many guys have said that to me and whatever. But it was just really, it's just sort of a weird thing. Just it always come full circle anyway.
Right.
So, but anyway, back to Lotus. So I put everything in Lotus, and I tried to get the math to work. So I put a score on each of these. I try to quantify each thing. So I put a score on each variable, and then I had sort of a constant score and a magnitude. So if the Fed policy was easy, it would be one score. If the Fed policy was tight, it'd be another score. And I tried to put it all together, like I said, into this stew on a 1 to 5. I don't know why I didn't do 1 to 10. I did 1 to 5 to try to get it to, you know, 5 being the highest, 1 being the lowest. And I couldn't get it to work. And I especially couldn't get the catalyst to show up in terms of to be enough of a fact on the total score to get me involved in it. Right? In other words, I used the catalyst too, and I kept messing with it. I kept increasing the catalyst, the magnitude, the strength score to get it to show up in the math of all these hundreds of variables, and I just couldn't get it to show up.
Right.
So the great insight was to get rid of all the other stuff and just focus on the catalyst.
Oh,
which is what I did.
Oh,
And so I started thinking about it. I started thinking about my finance classes and all that. And I thought, okay, what am I really doing? Because I remember I'd learned about unsystematic risk and systematic risk.
Okay.
And for people that don't know what that is, systematic risk is market risk. Unsystematic risk is risk that's specific to a stock.
okay.
So a security, you know, the volatility and the viability of a company stock price
Right.
versus the systematic or the you know, the system, the overall market, right?
Okay.
And so my thing was, over short periods of time, I'm just going to focus on the catalysts because the event or the upcoming event has much more priority than anything else,
Okay.
right?
Makes sense.
So-
For that specific stock.
For that specific stock.
It means more.
So if a company's got an earnings event or a sales event or an analyst, you know, conference or
Okay.
whatever, right? So
Yeah.
there's, you know, or they're having, you know, with biotech, you know, there's a PDUFA date or there's a, you know, there's these different things.
Right?
There's all these events for different companies. And if you can get that risk right, then you can focus on taking unsystematic risk. And you're in terms of, if you look at the a chart and you say there's part of this part of the stock market or the stock's price is systematic and part of it is unsystematic. At the time when you're having these events, the unsystematic part is the crucial part,
Right.
right? And it's way outweighed the systematic risk.
Okay. Agreed.
So over that 2-week period or month period or whatever it is, you're actually taking much less systematic risk because within the risk component of the stock, there's much more unsystematic
Right,
during
okay.
that period of time.
Okay.
I hope your listeners sort of
Oh, yeah.
get that.
I'm sure they'll get it. And if not, they'll rewind.
So anyway, but that was really the insight. And so I remember I would meet with heads of desks, you know, after a few years, and they'd say, "Now, Mike, what's a catalyst?"
You
know,
mean
like-
heads on the sales desk?
On the sales desk, on the
Yeah.
institutional desk. They'd
They
say, "Now,
didn't
what's a
understand
catalyst?"
it?
They didn't really, because nobody was really doing this back then. It was pretty novel. This was mid '90s. So
I didn't realize that.
Yeah.
I know that I didn't realize as well that was how you started and that
Yeah.
you were at the forefront of this.
Yeah.
Because now there's lots of hedge funds
yeah,
doing this,
it's
right?
entirely. I mean, there's you know, the whole Millennium and a lot of the Citadels. You know, there's people that are focused entirely on trading short-term risk.
Right.
But back then, there was very few of us. There were some other things going on as well. If you think about what I was actually doing, to use, you know, options terminology, and I know you're fluent there, I was really doing a giant dispersion strategy.
Right.
Right.
Yes.
And if you think about what was happening from when I started from 1995 to roughly, you know, 2000, basically correlation went down every year. I mean, it was like I couldn't have picked a better strategy if I had tried. So I mean, you talk about being in the right place at the right time. I mean, it was literally the perfect strategy to start off with.
Right.
Like it was a giant dispersion book,
That's right.
With
You're
correlation going up. Correlation going down, dispersion going up.
Yeah.
You know, just to get the angles right.
Yeah.
So, anyway, so that's how I got started, and it was very profitable from almost day one. Like I think our first 36 months we made money every single month. We didn't have a losing
So your
month.
turnover must be huge then,
Yeah.
right? Like,
Yes.
so many hundreds of percent, or was that what it was?
Every bit of it. Now we've changed what we do
Yeah, no,
today.
fair enough. We're just
but
talking
at the
about-
time, but
we're
back
talking
then,
about
yeah,
that.
absolutely. So I mean, I just put taxes to the side and everything else, but it was geared for high absolute performance, you know, over time.
And would your trades all be on the long side, or were you also
No,
looking on the
both.
sell side?
Both.
Oh, you were looking at the sell
Yep,
side.
yep.
And
Much more on the long side because it was easier to discount. The discounting pattern was easier on the long side for whatever reason at the time.
okay. And could you give us an example of a typical trade during that time? Like, what did it look like?
Yeah, so let's say, you know, Teradyne, for instance, which is a semiconductor manufacturer. They were back then, they are today.
Yeah.
You know, they're in robotics now and all that. But basically, so they're coming up with an earnings event coming up. And, you know, this is pre-FD too, so that's
Right.
important.
And for those who don't know, FD stands for
Regulation Fair Disclosure.
fair disclosure.
Right. So at the time, if you were an analyst, you could say, okay, I'm going to call X, Y, and Z clients and say, you know, I just talked to the management of Teradyne. It sounds like things are going better. And they're by the way, they report it in a couple of weeks, or put out an electronic thing. Now, at the time, they used something called First Call. So they would put it out on First Call and just blast it out. Well, if you knew the analysts that were good, that knew what they were doing,
Yep.
that were effectively conduits for management, and you knew, you know, who mattered and like who would get that out into the street,
That's right. Like, so management would purposely use certain players,
Exactly.
or certain analysts to communicate
Right,
things.
right.
Just like how for a while with John Hilsenrath was
That's exactly right.
Right?
Yes.
Was the mouthpiece for the Fed for Bernanke, and I
Yeah.
believe there was someone that Greenspan used too. I can't remember which reporter.
For sure.
Yeah.
Yep. So,
And so-
Barry, Andrew Barry, I think.
Oh, that's right. Okay.
Yeah.
And so you had an edge in just that. Would you just watch the first call? Like, how did it work? I don't even know.
Well, so back then, it was literally like Bloomberg. It just rolled out headlines, and I had them, and I paid for it. It was like $2,200 a month, which at the time was a lot for a startup
for sure.
firm.
Yeah.
Um,
But it more than paid for itself.
well, of course it did. In most firms, they just assumed anybody paying $2,200 a month was willing to, they were probably paying them for research too. So even if we weren't actually paying for the research, which we did, we paid them a lot. But at the time when we were starting, we didn't really pay anybody because we didn't have any money.
That's right.
But eventually we paid them. But you got all the information, and we figured out very quickly how to source it and exploit it because we were used to. It was, I guess, again, it was a sort of a communications thing as well.
You would look for patterns in the way that it would come out and stocks, and you'd be like, this analyst, when he says this, we can expect this.
Yeah, we actually rated them. I went back to the strength scores and all that. I actually used that to rate these analysts, and I had, this is a 10 rated analyst, and this is an 8 rated analyst.
And so you're doing all this in your loaded spreadsheet.
Yes.
So you were kind of almost a quant.
Yes.
But you used a spreadsheet.
Yes, exactly. Yeah, I didn't code.
But
I still don't code.
But it was a lot of numbers that you were.
It was a lot, but it wasn't that bad because it was fairly. You'd get. You didn't expect to get hits every day. You may get 2 or 3 hits a day, different names, and then around earnings periods you'd be busier, and so you would be taking more market risks collectively around earnings periods. So you could sort of get hurt if the market was going straight down in an earnings period, and it was sort of, missing the unsystematic risk, right? Yeah, the main thing we were focused on was making sure there was enough unsystematic risk in terms of the total amount of risk that we could exploit. That was really what we were looking for.
Right, because if there's enough of that, the systematic risk just kind of gets.
That's right. It just was obviated.
And so let's go back to the paradigm. So you see this, you're watching first call, you see it, and you say, this analyst. The guides up or increases his expectation for earnings that it's in 2 weeks, and so you get long almost immediately, and
right away,
and you just hold it for the 2 weeks into the, and then when the event occurs, assuming it behaves correctly, you sell into the event.
You can sell before the event, you can sell on the event, but back then, if you think about it, the information was pretty much straight from the horse's mouth.
Yeah.
So. Management was already sort of communicating to people that, hey, we're going to beat the numbers. And then so when they beat the numbers, maybe there were some people that were surprised.
Oh, I see what you're saying.
The reality is there shouldn't have been a surprise.
The game actually became selling before because everyone was doing the same game. And everyone
eventually.
Yes.
But not for a while.
Okay.
Because there weren't that many arbitrageurs around.
Right.
And there were more and more.
And then what... you're there, Regulation FD. Why don't you tell people about how that came about, what it was, and how it changed the game for you?
Well, so FD really, what was happening is there were more and more people doing this. It was a great deal for brokerage firms because brokerage firms had this sort of conduit that management would talk to, which made them very valuable from a commission flow standpoint. And people wonder why brokerage firm revenues went down after that. That was a big blow because suddenly that conduit that they had went away, and firms weren't allowed to, sort of selectively disclose to clients, this kind of information.
Right.
And it was legal. It wasn't like it was this. But after that, they had to disclose everything sort of at once.
Fairly at once. And then so how do you adapt?
And the mutual funds, I think, actually pushed that because they were sort of mad because they felt like, well, you got all these hedge funds, or they're out there taking, you're getting an edge over us, right? And you're
even though they were free to work as hard as you, but
exactly,
exactly, but they didn't want to do that, so they changed it. So how do you adapt to this? What new things do you do in terms of your strategies as FD comes along? Is there enough different strategies, and you're always evolving and changing?
Well, I had to change, right? Yeah. So I was fortunate enough to sort of have a strategy, and the nice thing, if you create one, you say, well, I've done it before. I
Right.
could probably do it again.
Okay.
I just have to think about it.
Yeah.
So I hired some philosophy guys from NYU that specialized in epistemology. Epistemology is like thought construction. If you're
Seriously?
familiar with it.
Like
Seriously, we
you
hired 3 of them. Yep, and we brought them down. I had moved my firm down to the Caribbean at the time.
Okay.
And,
So what island were you at?
I was in St. Croix.
Okay. So you're there,
Yeah.
and you say to some 3 kids from the philosophy kids,
Yes,
please come down to the Caribbean and
Right.
help me with this.
yes, and we paid them. They loved it. So
No kidding, they love
well,
it.
and the crazy thing about, by the way, NYU, I mean, in Western philosophy, it's the number 1 Western philosophy school in the world,
Okay.
right? So, but at any rate.
Okay, so tell me what the philosophy kids, why you hired them, and what was the thing?
So because I was sort of, twirling around trying to figure out, well, I've got, this was effectively the problem. There were a lot more ARBs, in part due to our success. Stevie Cohen was doing, there was plenty of other guys doing this.
Yeah.
There was a lot of ARBs, and there was less information. So if you think about an investment situation where there's a lot of ARBs and not a lot of information, that's a problem.
Okay.
What you want is the opposite,
Right.
right?
Yeah.
You want big spreads, and you don't want a lot of participants. And
Yeah,
you can exploit the spreads.
Okay.
So, basically, we started looking at the participants themselves more. We shifted our focus to really looking at the participants. So we thought we're going to start discounting the behavior as long as people continue to listen to analysts, even if we know they may or may not be right on the event. The fact that people will trade homogenously, there will be a homogenous narrative that's espoused by the street and that shows up in price formation, we can discount that. So we started discounting the ARBs themselves because we were like, there's a lot of ARBs, so we can exploit that.
And is this what the philosophy
That's
kids
effectively
helped you with?
yes, that's effectively the insight that we finally came to, which was like, why don't we just exploit the ARBs rather than exploiting the information?
Oh, that's fascinating. Okay,
So that was a nice evolution of the strategy.
And so at this point, you've moved down to the Caribbean, and you have the 3 philosophy students. Do you have a couple of traders? Like, tell me a little bit about the evolution of your firm at this point.
So at that point, I had about 10 people. I had a trader, Tom Peel, who had retired from the sell side, but he had retired like in the late 80s.
Okay.
And so all of his friends now were running desks on Wall Street. And so I came, as I mentioned, from a retail background, and so I didn't have those kinds of connections. And so he joined me in 96, I think, maybe 97, and helped me really establish credibility with these institutional desks. So we'd fly up to New York.
Okay.
I originally cleared with Montgomery in San Francisco. So first we'd go out to, Robbie Stevens or Hamrick and Quist or Montgomery and, got to know those guys pretty well. And then we started, some of the New York banks, we started meeting with them. And
So just because you wanted to be in the flow of the institutional traffic.
well, we could get flow. We could flow trade because we would get flow, and we could be useful to desks. As you're aware, I mean, there's accounts that once they know you can work with them, and we've always tried to be very straightforward with desk and work with them.
Okay.
And so that was helpful, and it was helpful in terms of we were. I'm sure they were watching some of our trades too, and saying, well, these guys are usually, they're usually pretty good, so I want to,
And at this point, you're still just trading individual stocks. Like, what would the typical portfolio of yours look like? Was it also still focused on trying to take only the idiosyncratic,
It was entirely focused on just idiosyncratic or unsystematic risk.
Right. Okay.
Right.
And,
So it was rotating a lot.
Okay.
30 or 40 names probably in general, overall, but there would be 30 or 40 different names all the time.
And so now you said that you were watching the ARBs. So would you get into a situation where you would get at something where you'd realize it was maybe too full, too many ARBs, whatever, and then the bad news comes, and would you be like picking up, like going, oh no, you know what, this is it? We're trying to pick up the scraps. I mean, not the scraps, trying to catch it because you knew that it was overdone because there was too many ARBs in it. Or would it be the opposite? You'd be looking at situations going, this is too full. In fact, that now it's a situation where we can go backwards because if something goes wrong, it's actually going to go even more the other way because of the positioning.
Yeah. Well, so generally there's you're calling the perception trade, which is separate and distinct from the actual event itself. So
Right.
an event happens, that's one thing.
Yeah.
And then there's perception. And you have this expression, never the twain shall meet, right? Because if you think about like a horse race or a baseball game or something, people bet on what the outcome is going to be.
Right.
And then there's the game or the horse race, right? Where you actually have that event and that event happens.
Yeah.
That's a separate thing. You can,
You're
horse
betting
that's-
on the betting.
right.
Like
Exactly.
It's
You can bet on the bettors.
It's the Keen's beauty contest.
Exactly. You can
Okay.
bet on the bettors.
Right. Okay.
Or you can bet on the event.
And so would you be betting on the bettors almost exclusively?
Almost exclusively.
Okay.
Now, sometimes we take event risks if we felt like we were going to, it was very asymmetric. For instance, if we knew everybody was very, very one way on an event,
Right.
and we thought, and especially like with options, and we thought vol was reasonable, or we could set up a trade whereby we felt like that the asymmetry was not priced correctly in the option market,
Okay.
then we would take the other side oftentimes.
So far we've only been talking about stocks. At what point do you start trading options and how do you use them?
So we started trading options more in the early 2000s, and again, the reason for that was because without FD, we had to be more creative and do other things to try to continue to be successful ARBs.
Okay, and so now you wander into the option square. How does that go at first? And like, what was the learning curve like?
It was okay. I mean, you learn all the Greeks. I mean, it takes a little while. I mean, you're any new options traders, almost exclusively, they focus on delta.
Right, yeah.
Right. And the problem with focusing on delta, as you know, is, there's 3 or 4 other Greeks, right?
Yeah, yeah.
I mean, not to mention speed and all the other stuff,
Yeah.
the really, the more esoteric stuff. And it's really important to focus on those things.
Yeah.
And I found that even recently, most professional managers that I know that trade options typically focus too much on delta and focus too little on the other Greeks.
Really?
Right.
Like even amongst sophisticated
Even among
PMs.
sophisticated PMs. Or
Yeah.
they focus almost solely on vol and things like that, and they don't focus enough on delta. Right. So there's this idea of a fundamental quant that's sort of a unicorn, right?
Yeah.
Where are the fundamental quants right there? So, and that's what we try to do. We focus on both. So
Okay.
we tend to be very focused on delta, but we also focus a lot on vol, where vol should be what's fair, what is the event we're trying to deal with, and we also focus a lot on time. And that's a really big thing for trading, is we're focused on time. If you said, well, there's an event happening, or, people, you hear people say, I like XYZ because it's this.
Yeah.
Like the first question I would ask is, well, over what time
Right.
and why?
Yeah.
And can you live with the volatility between now and then?
Right. And it's also even doubly important in terms of options.
Absolutely, 100%.
And then your skill set of knowing the catalyst becomes even more important.
Correct.
And so,
And if you think about when you're selling vol before an event,
yeah.
you're always selling fairly high price vol.
Well, that was going to be my next question.
Right.
Did you adapt your option strategy to be such that you would, not only are you focused on delta, but you might go and say, we expect there to be more interest in this event coming in the next 2 weeks, and we could see a situation where not only could the stock go up, but we could also see vol going up.
Absolutely, because
Okay.
we're trying to offset. If we're long that premium,
Yeah.
we're trying to offset our daily theta bill, right?
Right. And so now my next question was going to be, are you ever short vol?
We are, but not overall. We're always, I've always been net long vol.
What are the situations
Long
where
gamma.
where you're short gamma? Is it in an individual situation, or is it? do you
It's
put it
generally
on-
more market stuff. If we're short gamma or short vol, it's going to be more market stuff.
Meaning that you have a view about the market. and
Well,
you-
maybe we're long a portfolio of single stock vol, and
Yeah.
we want to be short some index vol. against that.
Back to your dispersion trade.
Exactly. Exactly.
Okay.
But generally we much prefer the long ball position, and I don't think we've ever been not long ball in our fund.
Right. So your theta is always a negative.
We always have negative theta. Right?
Okay.
I mean, we just deal with it.
You
saw that what was that thing on Twitter the other day with the guy laying there on the hospital bed theta?
That's right.
Right. I mean, I love that.
Well, Jimmy Jude said something about Jimmy Jude is a guy we've had on our show. He's a terrific guy, and he was an option maker, market maker down in the Eurodollar pit, I believe, and maybe the crude oil pit as well. And he said that he had a boss that told him that being long too much theta was like dying by being suffocated by 100 fluffy pillows. And and I, as a market maker, everyone, a lot of people use options. They use them for risk control, and they're buying a certain amount, and and I get it. They're almost welcome when it doesn't work because they know how much they're going to lose, right? But when you're a market maker and you've gone and you've got this big, huge theta that's sitting there, and you need the market to move a certain amount every day.
That's right.
And when it doesn't happen, and you're just staring at that P&L, wondering how you're gonna, make it, it's brutal. Like I always joke and say, I'd almost rather be short vol in a crisis, because at least I have a chance of making money somewhere else. Yeah. Yes, I'm getting whipped around and it's ugly, but I got a chance. Yeah. Whereas when you're long theta and nothing's happening, they're just ugly, ugly, ugly. Yep. Okay. So now, in terms of your strategy, is it always like when you and I speak, we speak a lot about macro stuff. And I don't know if that's just because with me, like you're just only speaking with macro stuff, but you're amazingly fluent and up to speed and seem to be making that a priority. How much does that go into your thinking in terms of when you're constructing your portfolio and trading?
It goes in a lot because macro really matters, and it matters more than ever before. There's a lot of participants that, as you know, are macro traders. And that's a whole participant group that you can discount. Right, so that's a classification that we would discount those macro traders, right? But there's a lot of things that macro traders do, that single stock traders do too. For instance, going into a non-farm payroll report. Yeah, you can trade the perception. You don't have to trade the event. Right, you can just trade the perception going into that event. Is everybody think it's going to be strong? Well, the market's going to move a certain way into that report. Does everybody think it's going to be weak? What's going to move the other way? Okay. Right. Vol's going to typically go up. It's not going to decline, right? So there's strategies that you can do there. And then once the event happens, depending on the positioning going forward, that's going to accentuate or amplify what's happening, right? Okay. So we just try to be knowledgeable about all that stuff so that, because, now with the quants and the computers that do all the stuff, if the bond market moves, and they're going to move everything I own in a stock portfolio a certain way too. So you have to be, cognizant of that.
And that's I don't know about you, but I found that relationship between, let's say, long rates and let's say the value trade versus the tech trade, it seems to me that that's becoming more solidified, not less. Do you agree with that? And do you think that's a function of more and more like renaissances and stuff trading those relationships?
Yeah, I don't know. I mean, I think it happens. I absolutely. Sometimes I think I'm just a bond trader because my portfolio it's just moving with the bond market, right? So I'm very sympathetic to what you're saying. I think though recently it feels to me that some of that correlation has been breaking down somewhat on because it doesn't happen like it used to happen every single day. Like it was just you'd pull your hair out because you're like I didn't go to work to become a bond trader. Like, here I am, I'm betting on red or black, whatever. And so I have a lot of thoughts about that, but I guess I would say that I do think that the bond market is a big input for a lot of quantitative programs. Okay. I do think also though that broadly, that the bond market is less and less important in the world that we're in because it's, people are more and more aware that the central banks really, basically dwarf the activity in the bond markets, especially so in Europe, but even definitely in the U.S. and in Japan. And if you're really looking at the bond market as your arbiter for what economic activity is going to do, you're probably not really looking at the right indicator anymore.
So do you feel like the bond market is starting to lie in terms of, because the central banks are such a huge portion?
I think it's been lying for a long time. I don't think it's a very good barometer. I think company-specific information, everybody, look, equity guys, we're at the bottom of the capital stack, right?
Yeah.
I get it. And then people also, especially bond people say, oh, you equity guys, you're idiots, you're an equity trader. I mean, where I'm coming from. All the desks, they say this. Because the bond, look, we're bond traders and we're supreme beings and all this other stuff. So, but the problem is they're looking at, economic reports, and they're really, like I said, they're betting on red or black every day, right? I mean, is it going to go up or is it going to go down, and why, blah, blah, blah. But I'm looking as an equity trader at a portfolio. I may have 100 names, and I'm hearing from managements, hearing what's going on. I'm getting a lot more variables and inputs.
Okay.
And so I feel like I see a lot more than you just looking at, reports that come out, once a day at 8:30 in the morning, and you figure out, what's happening in the world. It's not that those things aren't important, but there's a lot of other stuff that's important. There's a lot of other information that's important, and oftentimes that information may be ahead of what you're showing up in the bond market reports. That's all I'm saying. I'm just trying to give, the equity guys a break here.
Now, I saw Stanley Druckenmiller recently talk about the fact that what he used to watch in terms of the movement within the stock market, meaning, one group over another, that was his bread and butter. That's how he kind of got a feel for what he thought was happening in the economy and stuff. He thinks that's becoming distorted, and that's no longer giving the proper signals. Do you feel the same way?
No, I still think you can see signals from there, but it's not easy, and there's a lot of noise, and it's not every day. Like some days are just weird days that you see something, you're like, this doesn't make any sense at all from a sort of the way you would formulate it as an active manager. And I think a lot of that's due to there's so much passive, there's so much more quant. There's going to be days you don't really understand what's going on.
And so do those days you just try to say, okay, that's one of those days, and you go back and say, tomorrow I'll watch and see what happens, and you try to just dismiss it?
I try to look at individual, again, go back to individual names and say, okay, well, what should be happening here? Why is this happening? What's the, what is there something that I'm missing? But at the end of the day, I feel like that there's just a lot to noise, to Stan's point. But I still think there's viable information from sector dispersion.
It's just harder to figure it out what it's trying to tell you.
I think you can look at it, and I think you can bring it out if you're a tape person. But it's hard. It's harder than it used to be.
And so let's progress a little bit to the macro environment. And I must say that when I've met a lot of people as successful as you, they've generally spent their careers in an environment of the last 4 decades of disinflation. Yeah. Lower rates, kind of lower inflation, the idea that everything's going to be met with kind of the Fed cutting rates, and it seems to me that most hedge fund managers, their go-to trade is to buy Eurodollar futures because that was always what made everyone the most money. One of the things I've been impressed about you is that you seem to be able and willing to shift and to say, no, maybe we're not in that environment anymore. Maybe the world has changed. Why don't you tell me a little bit about whether you used to feel like those other hedge fund managers, and when you started to notice that you thought that the macro environment had changed and that the old playbook needed to be thrown away?
Well, I thought, for a long time that, like a lot of traders did, that the Fed, easy policy could cure a lot of ills. And, you bring down the borrowing rate, you increase, the DCFs for company, discounted cash flows for company, you bring up multiples, all that. But it's got a lot of problems. And I've thought that for some time. I probably thought that for 5 or 6 years, that there's problems with that. And there's inequality is an issue. You bring up when it's just the Fed doing things, you're not really doing a lot for regular people, in my opinion. You're helping financial actors, but in my opinion, you're not doing that much. I'm talking about just exclusively monetary and not fiscal.
Right. Okay.
And so today, I think that the world has changed, and we've talked about this, but I think the world has changed where the whole political economy is different, where we're now doing fiscal as a focus. And I feel like that monetary policy, which an entire generation of traders is still focused on monetary policy and every move the Feds makes and whatnot. And I think that they would be much better served looking at what's going on fiscally wise around the world, because to me, that's much more important right here, right now.
And when did you come to this conclusion? Was it a gradual process, or was COVID your point where you said, okay, now this is it? This is the tilting point?
Honestly, I've been thinking about it well before COVID.
Okay.
I think though with COVID, what COVID did was it changed the game, because it allowed people to in practice, government policymakers to do fiscal in size without any really restraints. And it also allowed, importantly, the population to receive fiscal largesse for really the first time. In the United States, when they first sent out checks right after, in March or April of 2020, maybe it was May, I can't remember, but when they sent out those checks, a lot of people thought, I had conversations with people. They're like, "Well, should I send this back? Don't they need the money? Whatnot." And as that they don't need the money, and they're not going to run out ever. Right. And so it was just but the average citizen didn't really understand. And in fact, the government really didn't have any good apparatus for just sending out checks.
Yeah,
they had to sort of figure that out.
Yeah.
Like, how do we actually send out a bunch of checks?
Yeah.
Right? They had to figure it out on the fly.
Right.
So people got the checks, and I think people thought, well, I've got these checks, and well, I guess I'll just spend it, right? Or I'll save it, or I'll put it against debt or whatever. But I think most people, by and large, at least spend a portion of it.
Yeah.
And then we did it again.
Right.
A few months later, we sent out checks again.
Yeah.
And then we did it again. Right?
Yeah.
The third time. And now on Wall Street, 3 times is a trend. 2 times is, but 3 times definitely is, right? So I feel like that people, getting those checks, they understand. They're like, wait a minute, this is all right. I like this. I like getting checks, right? And I think it's very interesting. It's a different prescription than what we've done before. And if you look at the counterfactual of what would have happened to our economy and world economies had we not sent checks out, I think it would have been much, much worse. And I think everyone knows that, right?
Oh, I think there was a reason. Think back to how bearish everyone was in the March COVID lows.
Sure.
And the reality was, the reason they were so bearish was because they didn't anticipate the government doing the fiscal.
Right.
And they probably weren't wrong. Right. Had no fiscal come,
it would have been very bad.
Yeah.
I
probably would have headed a lot lower. All those bears would have been right.
Yeah.
And where they fell down was missed, forecast was they didn't understand that the fiscal that was coming. And to be fair to them, we've spent years being told that we couldn't do it.
Right.
Like the Reinhardt and Rogoff book telling you that, no, we can't do it.
Yeah.
And now we got a situation. Okay, so you were already, though, leaning this way. Mm-hmm. And you were leaning this way because, I guess, after decades of seeing lower and lower rates, but really the credit going to the elite few or the people with money as opposed to that. So you almost would say, or am I correct in that you would say this would have triggered at some point for some reason? We just couldn't go on the way it was.
Yeah, I feel like that, honestly, like the way these things typically change is some big event.
Right.
That's and it finally just shifts people's expectations.
Yeah.
But because I was, I used to use this analogy. I'd say, imagine if you're a king in Europe, and I'm really sort of picking on Germany and sort of the fiscal austerity framework that they have.
Yeah. Okay.
Right.
They're
Which was, to me, I mean, it is. And it's honestly, it was literally the opposite thing of what you probably should have done, after this long debt deflation that we had, after the financial crisis. I mean, you probably made it a lot worse than you needed to make it.
For sure.
Literally doing what they did.
Yeah.
So, but if you just sort of take it out of context and you say, okay, imagine if you were a king in the 16th century.
Okay.
And your finance minister came to you and said, okay, there's all these people, they want to give us money to do stuff. And, the crazy thing is they're actually going to pay us to take the money. So you say, well, what are you crazy? Like, what do you mean they're going to pay us? Like it's a negative interest rate. So they're going to pay, we get the money and then they pay us to take the money.
Right.
Right.
Yeah.
And then the king would say, well, does it matter what we do? No, you can do anything you want.
Yeah.
That's the way it is.
Yeah.
Like, how long would it take the king to take all the money that he could and then spend it on armies and go and rape and pillage or do whatever, right?
But he is German, though, so he might not.
Well, maybe not in Germany. But most kings, I think, would have taken the money.
Yeah.
I mean, they may have taken the finance minister and said, you need to go and be in the stocks because you've lost your mind. But I mean, it's sort of this weird sort of Alice in Wonderland world. It's like, just take the money.
Yeah.
The bond market is begging and screaming you to take the money. It's negative interest rate. They want you to take it so bad. They were paying you to take it.
I know.
Take the damn money and use it. So I think that's where we are. In COVID, people were like, well, we can take the money and spend it.
Right.
And then when they did it, people were like, well, man, this isn't so bad.
Yeah. Now, do you worry, though, like I always say, the government can fill the hole, the COVID hole, but I almost feel like that they might have filled it a little too much. And that's what we're seeing with some of the inflation. Obviously, we have some supply issues as well, but maybe we did a little too much. And now we're seeing for the first time a return of that. Larry Summers got to balance the budget, and you see some of the Democrats heading, not as willing to spend. And do you worry that we're going to slip back into, let's just say, the Clinton Democrat, the who was it, Rubin? That was, let's stop spending, and so that'll do better. Do you worry that that's where we've headed back for a little while?
I think it's possible. I don't think it's very, I would bet that we continue to do some stimulus. We may do less than maybe they would formulate it to begin with. Now, there's a political process. Remember, people say up front, I want X, when they really want X minus, right? Whatever that is. So to start off with $3.5 trillion doesn't mean you think you're going to get $3.5 trillion, right? Maybe it means you think you're going to get $2 trillion or 2.5 or whatever. In terms of this latest reconciliation bill. And then, of course, you've got the infrastructure on top of it. I think the Democrats would like to do some stimulus. I think they would like to extend child care credit. I think they'd like to do other things. And I think, my view, I think they'll figure that out in some form or fashion and get that done over the next, 3 or 4 months.
And do you think that will be enough for what the market is discounting? Like, do you think that they will
I don't think the market is particularly optimistic about that, number one.
So do you think it'll exceed market expectations?
Well, I think any deal probably right now exceeds market expectations.
Yeah.
I feel like people are sort of talking about it, but nobody, until you really see what's happening, nobody's really, I don't think, discounting it too much. I also think there's a fair amount of pent-up savings that's out there, and there's clearly a wealth effect as well.
Right.
But there's a lot of pent-up savings from people. But I think there's a bigger point to the point you're making here, and that is that as market participants right now, we're primarily focused on COVID and after COVID. COVID, we're through, we're in COVID, somewhere, getting through it or whatever. And what's going to have after the COVID? And people look at supply chains and they're saying, well, this is just because of COVID and whatnot. And they're ignoring the last decade of debt deflation, which Reinhardt and Rogoff also talked about.
Right.
This time is different.
Yeah.
Right. Which they were largely right about, the fact that, after a financial crisis, that the world takes a long time to heal.
Right. They were right because they convinced everyone to not spend anything.
Well, that didn't help,
Yes.
right? So maybe they made themselves
That's right.
Okay. But the reality is clearly with austerity, you make it worse, in my view. So But if you think about the last 10 years and you think, okay, so let's look at housing starts, right, over the last 10 years. This is pre-COVID. You had 3 industrial recessions. You had a financial crisis and, second sort of financial currency crisis in Europe with the ECB.
Right.
In the EU, then you had, a 2.5-year trade war just preceding COVID. So there was a lot of stuff going on, especially in the industrial economy, the sort of the value start of the economy, right? They had a period of slow growth. You had the whole oil issue where people, were fracking, and then they refinanced them, and then they blew all the money again, and so that we had a lot of issues during that period of time. But the big overlying issue was that things were basically slow because regular people didn't have any money after the financial crisis. They lost their jobs. Yeah. Some of them lost their houses, their assets. A lot of people, look, everybody talks about the stock market now. Look, a lot of people sold. Right. In 08 and 09. Yeah. They got out because they were scared. They were losing their house. Some of them lost their savings, their house, all that. Their credit went bad. They lost their jobs. There was a lot of pain. Yeah. And meanwhile, banks who had financed all this stuff, with 30 times, 40 times levered balance sheets, they didn't have any capital either. Right. And so one of the reasons the Fed had to do QE was to rebuild the bank's capital. And so you had banks rebuilding their capital. You had consumers rebuilding their balance sheets. These things take a long time. Okay. It took a decade. Right. Right. But as I say, time heals all wounds. Right. And with the COVID stimulus and all the other stuff, we're back. Like, banks' balance sheets are best they've ever been in history. Consumers have fantastic balance sheets. They're the best they've ever been. Look at the NCOs from the companies that are reporting. The banks reporting the charge-offs. Right. This week. So if you think about, this last 10-year period and the next 10-year period, what if the next 10-year period is actually a regular period, and the last 10-year period was actually a subnormal low growth period? Right. That in actuality, supply chains were optimized for this low growth period, and now they're having to optimize for a regular growth period that's just a normal period, a way things should have been without a financial crisis. Right. Okay. So we went up and then we went down, and now we're going to normalize again. Right. So I mentioned housing starts. So to go back to housing starts, we averaged 900,000 housing starts from 2010 to 2020. The decade before, we were at 1.5 million, 1.6 million a year. Right. So if we just get back to where we were that decade, we're short 6 million units housing. Yeah. So people say, well, housing prices are up. Well, of course they're up. Where are we going to come up with 6 million houses? Because that's what we got to come up with. By the way, I'm not adjusting for population. I'm not adjusting for all the demographic changes. Right. Right? I mean, the millennials are having kids. Right? And by the way, they're moving out of apartments. And what do they want? They want houses. Yeah. So it's a different world. And everybody's focused on COVID and what the supply chain effects are with COVID, but they should be thinking about this from the last decade. This decade is very unlikely to be like last decade. And the big thing that you're talking about, that people aren't talking about, is the fact that not only are we not doing fiscal austerity anymore, like, the absence of a negative is one thing. Right. We're literally doing the opposite. Yeah. And not only are we doing the opposite, we're doing the opposite in size, unprecedented in size since World War II. Right. In some cases, larger than World War II. And not only are we doing it, Europe's doing it, Japan's doing it, China's doing it. The whole world, the developed world is doing it. Okay, so now I would argue that parts of the stock market haven't figured that out yet. A lot of them. I mean, the whole value sector hasn't figured that out. Okay, so why don't you explain to people why you think that the value sector would benefit from this change, and maybe tell us why you think they haven't figured it out yet.
Well, I think it's everybody's a prisoner of their own biases and a prisoner of the most recent past. And heuristically, we all overweight the recent experience the most. Okay. Our brains do that. Right. So it's this. You can read the behavioral finance literature. I mean, just look up recency bias. That's what it is. So we're all looking at the past 10 years, and I think the assumption is well, once we get through this COVID, we'll go right back to the period of time like the last 10 years. Right. But what I'm saying is the last 10 years were an anomaly for a lot of reasons. We did the wrong kind of economic policy, and we had to really delever. And I'm not talking about government delevering because they're totally different. I'm talking about the individuals, the private sector, which these are the ones that matter. Right. And because the governments can print it and banks. So, but today everything's different. Banks are healthy.
consumers are healthy. And by the way, we're not doing that. We're not doing austerity. We're doing the opposite. We're doing stimulus. And people think, well, we're going to go back to this sort of secular stagnation framework. I just think that's wrong. It just feels to me like we're in a much different environment. And because our supply chains were built for this slow period of time, we have to completely change our supply chain. So imagine the guy that's providing supplies to the home builders on a 900,000 run rate. And suddenly this year they say, well, we need 1.5 million houses. And you're like, well, that's going to take some time, right?
Yeah.
And think about that throughout the entire economy. Think about that with ships, with container ships, and with steel, and with aluminum, and all these different commodities. Oil, energy. We're going to build a brand new green energy infrastructure? Great. Well, that's going to take more energy, not less.
That's right.
Because we have to use the energy we need to begin with to continue to sustain life. And then it's like growing. Like when you're growing, you eat more, right? You're a growing kid, they all eat a lot. Yeah. Well, if you think about that with the energy infrastructure, you have to use more energy to create this new thing.
That's right.
In addition to sustaining yourself, right, to get to that point, right? So it feels to me like it's very reflationary. And that, if you think about that kind of environment, that's traditionally benefited value. And it's a higher growth environment than we've seen for a while.
Right. Now, you talk to a lot of smart people and a lot of, the hedge fund managers and endowment guys. I think one of the things that we've discussed is their reluctance to jettison their top 8 technology stocks. The fact that they've owned the Googles, the Amazons, the Facebooks of the world, and it's worked for them, and they're still stuffed to the gills with it. Do you see any signs of that changing? And when do you think that trade might finally start to hurt them?
Well, I think people that own those, if you own those and if you're in the long only community, you're paid on relative performance, and that surely means you're measured versus some index. And because the indexes are so heavy with those, it's very difficult for you to underweight those if you're competing against that index. I mean, because the indice, it's just too much.
Right.
We have an expression in our shop: the world is short gamma. Right. If you think about how long-only managers, most of them are paid. They're paid on a relative performance benchmark. So, not surprisingly, that's what they care about.
Right.
And so, when they're thinking about Google and Apple and Facebook and all the names that are in this list you mentioned, or I assume that's what you're talking about. The technology names.
The top 8.
The top 8.
And actually, someone pointed out to me that the 9th is Berkshire, and it has 40% Apple. So it's almost
there you go.
It's almost the top 9.
And by the way, it's the largest component of the XLF, which is interesting. So you don't know if you're buying the XLF, you're actually buying Apple.
I did not know that.
It's the largest component. People are like, I'm going to buy the banks, I'm going to buy the XLF. Well, look who's the top. But at any rate, it's a good question. My sense is they're not going to do it very quickly. If it happens, they're going to be drug out. I just think it's too much career risk for people to say I'm going to just. Even if they should do that, it doesn't mean they can actually do that based on the way they're paid.
But one of my thoughts when I listen to you, and your first instinct might be, Mike's real bullish. This, lots of growth coming up in the next decade. That means you should buy stocks. But one of the worries is that if you buy the broad market, you're going to be getting a lot of the stocks that have benefited from this previous slowflation, right? And one of the things that you laughed about, you said, I feel like I'm just a bond trader at heart. And I do worry about the fact that those technology stocks are in essence the longest duration asset out there.
Yeah.
And that people are positioned in the most heavy, the longest duration. It's almost like they're, chasing yield, the fact that the interest rates are way down, and instead of just accepting the lower rates and waiting for higher rates in the future, they're going out and saying, I'm going to go with 30 years.
Yeah. I think, in regime change, it takes a while for people to understand what's going on. I just don't see them moving very quickly to move out of those names.
So sorry to interrupt. You say that in regime change. What would be an example of something that would change your mind? Like you've laid out a very compelling case about where we're headed and stuff. What would be this like something that would give you pause and say, hey, maybe I'm wrong about this?
Well, I think if suddenly we just did a full reversal on our political economy, if we said, we're going to quit deficit spending, and we're going to try to just,
like a Tea Party return.
Yeah, something like that. Something. Anything that really if we said, we're not going to spend any money and we're going to hike taxes just to make sure that we can balance the budget, that's a whole different issue. I mean, I think that'd be a big depressant. I don't think that's politically likely from either party.
Okay.
At this point, because, all of them know that it would likely cost them the next election. So, because they know that spending money, helps.
Right.
And so my sense is that's unlikely, but it's certainly possible.
Right.
And you could say, well, what about the rate of change if things really slow down? And I think you may have alluded to that a little bit earlier. I'm less worried about that because of the sort of the lingering effects of what we've done so far. And I would say something else too, which nobody talks about, but I think it's very important. And that is that we all know collectively, market participants, about monetary policy and how it works and so forth. Well, all of us know very little about this kind of fiscal policy. We know very little about its effects on the intermediate and long term. We just don't know. Yeah. No one really knows. Stan Fisher, who's, former Fed vice chairman, made a comment a few years ago, and he said, we know how to stimulate the economy. And he's talked about fiscal a lot. Right. We can do fiscal and have the Fed monetize it. That works. We know what we need to do if we need to. He said this in 2018.
Okay, so before COVID.
Before COVID. So, it's not surprising that we did this playbook.
Right.
Right. Because, thoughtful people at the Fed had talked about it, and thoughtful people at Treasury had talked about it.
Right, okay.
And by the way, this was a bipartisan thing that we did.
That's right. We forget that, but everyone agreed. Yeah.
Everyone agreed. We've got to do this. Yeah. This is a situation where you've got to spend money. And so all the deficit hawks and all that, they put them in a room somewhere and said, don't come out. Anyway, so but they also said, but we don't really know if we create inflation through that process, we don't really have a rheostat. We don't really know how to turn it off.
That's right.
Right. It just sort of persists. Right. And
so I completely agree.
And that's an issue, right? We don't. And is that bad or good? I mean, I would argue that some inflation is actually pretty good. We really need it in some ways. So especially after the sort of the deflationary decade that we just had. I mean, that's not helpful for broader society.
One of the things I was thinking about was, because I've gotten a little more nervous about the market lately, and I thought, could I be wrong? And so I phoned up a buddy that's I respect a lot, and we started going through it all. And I started talking about the fact that at the margin, I felt like the Fed was gotten a little bit more hawkish, and I felt like the fiscal had come off. And then he started talking to me about CapEx. And he said, nobody's thinking about CapEx. He's thinking about all the onshoring, all this. And we forget as well that monetary, private sector credit creation has been so tepid over the last 10 years that we haven't seen any.
Yeah.
And what if we come back? And to your point about the housing, what if the housing takes off and we get a real booming, think about how much how much economic activity will be created from housing.
Right.
It's huge. So before I go, I have another insight that you shared with me, and you were talking about stocks at turning points. Mm-hmm. And you highlighted how stocks aren't very good at understanding the difference between a cyclical rebound and a secular change. And you had some great examples over the years of different stocks of this. Could you maybe tell the story again to me?
Sure. Well, I think the market has a problem in general conflating different time periods, right? Like I said. So right now the market particularly is focused on COVID, but they're not thinking about the secular issues of we had sort of a lost decade, and now we could be starting a decade that's a good decade,
Right.
From an economic standpoint, right? And so the market is sort of has to focus on one or the other. And I think what I was describing to you is if you've got an industry that's sort of secularly challenged, and one of the companies I was talking about, I think my example was a company called Gannett in 2008 or 2009.
Right.
And I remember it very specifically because we had bought it, I thought we had bought it pretty well. We had bought it in single digits. And in March of 2009, Gannett eventually went to $1. It was 1 times earnings, right? Because people were worried about the cyclical downturn of advertising,
Right.
which was true, which they were going through. They didn't have any close debt maturities or anything. They weren't going out of business. But I mean, it's just people, And then there was the whole aspect of the internet, and they're taking over, news and whatnot, which was true. But it doesn't happen like that day. I mean, it happens over a decade or two, right? It's over a long time, and the market was unable to really differentiate between that, right, at the time. And so I just feel like, and that's when you get really big price locations. And I think that to that point, one of the interesting things is in value, a lot of value names, if you look at where they were in March of 2020, they were at secular lows. I mean, of course, people were worried about cyclicality, but they went to levels that were so cheap. They went to levels because they hadn't done anything. There was literally any buyers in value that had bought those, by and large, they gave up. Yeah. They just said, they haven't. I've been in these things, and they don't ever do anything, and now here we are. I mean, there was plenty of names, copper names, and Alcoa, some of these names. I mean, they were single digits,
right?
Because people thought, oh, this is it, and they were in a sector that was out of favor.
Yeah,
and sometimes that. When you have those, that creates opportunities, and that signals that you're having something changing over a long period of time. Sometimes before a big change, the market gives you a great opportunity to buy things at sort of rock bottom prices. And so I think that may have been that kind of situation. But clearly they were with the value situation, they're like, it was value, and plus their businesses were bad at the time.
Right.
And people just couldn't look through it. They're just like, I can't own this stuff. And so you get these valuations that are really fantastic opportunities if you're willing to be contrarian. But It's hard because you have to go against pretty much the whole planet.
Okay, so let's end with 4 questions. Let's start with an easy one. Your favorite investment book?
So, I'll just say the books that helped me when I got started, which I think I'm sympathetic to your listeners. I mean, all the Market Wizards books, helped me, and I'm in one of them, the Stock Market Wizards, I think. And I only say that and the reason I did it is because his books helped me, Jack Schwager's books. So, and I told him that I was like, because I had this view that I don't need to. Talk to people or whatever, but I really felt like his books helped me a lot when I got started, especially the first one. I met, Blair Hull is in one of the early books.
Right.
And I actually met Kristen Hull at an event recently in San Francisco. And I told Kristen, I said, your father, reading what he said about uncertainty and things like that, that was very influential to me in my career.
That's terrific.
Right. So, because people want to hear that, and it's true. And they help me. So, and, maybe I've been able to, whatever I said, maybe I've been able to help people, in some form or fashion. But so I think, but there's a lot of books that are good. I think, basic philosophy books are good too, to try to understand, what you, understand what you believe in and why, because the market's going to test you, right? So I think that's important. It's important to sort of think about what you really believe and why. And if that's rational or not,
Okay. Are great traders, investors born or made?
I think probably a little bit of both. I think that, and I've mentioned this before, but I was a swimmer, and like pain tolerance is something that you sort of have to deal with as a swimmer. I mean, swimming basically is a sport. Like the practice is, call a spade, they sort of suck. I mean, it's hard. It's just brutal. And you get, if you get used to that and doing that, then you develop certain, attributes of dealing with pain, right?
Okay.
And I guess I think that so with traders, I mean, so with myself, so as going through that period, I know has helped me sort of be able to persist and being able to do things when I didn't really want to do them, but they were the right things to do in the market. And the really good things to do in the market are things, as you know, they're things that you don't want to do.
That's right. That's right.
Like they're like, you're like, no, I don't want to do this, but you should do it.
That's right.
Like, you do it. Right. And so I feel like that. So from an environmental standpoint, right, whether it's athletics or it's, just your, sort of your mental makeup or whatever else, I do think the environmental stuff helps.
Okay.
But look, I mean, everybody's different, and look, I grew up around people that were talking about markets. I'm sure that helped, but I'm sure there's some stuff that you need to have,
just the way you are.
Yeah.
Well, I remember one time on the desk they had a fellow in research that thought he wanted to be a trader, and they sent him down. They put him beside us. He lasted a week before he was like, just send me back to research. He just did it. He was not made to be a trader. Okay, so the next one I sprung this on Harley Bassman last week, and then I realized that it wasn't very nice of me because I should give people a little bit of a heads up. And so I gave you a heads up this time, and we're going to do Byron Wien. Byron Wien has his very famous, I think he's been doing it 36 years. He has his probables, like something that he thinks the market is underestimating a chance of occurring. And I was wondering if you could come up with one for us. Something that you think the market is priced for a 1 in 3 chance that you think has a greater than 50% chance of occurring.
So I think that the persistence of economic growth over the next 12 months will be stronger than people think. Like, I think a lot of people still want to bet on the under. I would say the majority of market participants are betting on the under. And by the way, they've been conditioned to bet on the under. They won a lot betting on the under the last 10 years.
Right.
And, old habits die hard. So, but I would say, given what I just said, that I think it's more likely than not, and it's not discounted, that the economy is stronger for longer and persist for longer than people think because of those things. And I don't think that's discounted in the market.
That's a great one. Okay, the final one, a young person that's starting in our business, what advice would you give them?
Probably just ask questions, talk to people that have been, if they're in the business, talk to them a lot, ask a lot of questions. The Socratic method works really good. Just keep asking questions, and then read a lot of stuff. Read, and not just read market stuff, but read about a lot of topics. Reading is, I feel like reading comprehension and reading is extremely valuable for what we do. You should be reading all the time about all sorts of things.
Well, on that note, Mike, thank you so much for coming. It's a real pleasure having you here. And now let's go out and get some dinner.
All right, Patrick, it's been 2 weeks and there's a lot to talk about.
Oh my goodness, is there ever? Let's talk some charts. But before we do, let's review the top 3 from 2 weeks ago. And then let's talk about what we're going to watch next week. All right. So we were talking about whether there was a bottom in China equity. And we were looking at a couple things, including whether or not the China internet stocks or the China A50 were bottoming. So far, the last couple of weeks, they've been more or less moving higher. Now, I'm just going to focus here on the China internet ETF. It's the symbol KWEB. It does look a little bit like a double bottom, and it's been working its way higher. But what's interesting, if you're looking at something like the China A50, it stopped making lower lows, rolled up. Nobody wants to touch China right now, but it really does seem like it stopped selling. It's maybe too early to call it a new uptrend, but certainly we've got a base, and it's being accumulated on the short term. Any insights?
Well, I would say that it's very unusual that we actually got the top 3 of something to watch, and it was something to watch. I noticed that our friend of the show, Lynn Alden, has gotten bullish on this.
Yeah,
and I'm the same way. I think it's one of those things. Everyone's written off China for dead. Nobody wants to own it. They're all focused on other things, and to me, it looks like maybe you can start picking away at it.
Right. All right. So let's. 2 weeks ago, we were talking about the OPEX and market volatility. And well, the only volatility that happened was to the upside in this period, like with that big snapback rally. But certainly,
that was probably you putting that one in. You always love talking about the increased volatility, and I guess the VIX has been straight down since.
Oh my God! Yeah, it's been as the market's been rallying, we're right down to 40. I'll pull up a chart of that a little bit later on, but it's certainly been. We're back down to the 52-week low of all. It's like everyone is suddenly not worried about anything, and option premiums are quite reasonably priced at this moment. Nonetheless, the last one, the number one thing we were watching were those inflation numbers, and they came a little bit on the hot side. Some of them beat, right?
Yeah, they were on the hot side. Having said that, there's a lot more worry in the market about the higher inflation numbers. So the question is, will they be able to continue to beat these elevated expectations?
Yeah. All right. So let's talk about the top three things we're going to watch next week. And well, certainly, I think the one thing that's on my mind is do these markets have enough gas in the tank to punch 52-week highs? And I mean, the NASDAQ isn't quite up there, but the S&P crawling right up along the highs. The SPY is kind of poked its head above, but the S&P futures have not. But certainly, they're poised to potentially be punching higher highs. Is it this simple? Just a quick 1 month correction that doesn't even tap anywhere close to 10% down, and then suddenly we're back off to the races. It's something I'm watching.
Maybe 6% is the new 20.
Maybe it is. I mean, do you have? What's your thinking?
I don't know. You know, in terms of seasonality, we're approaching the tendency. Like these last 2 months are generally the best performing months out of all of the whole year. So it's tough to get bearish and say that you're expecting a prairie dog here. But a prairie dog is a noble animal that shows up when everyone's least expecting it. We still have the taper. There's still lots of bad things happening. I don't know. It would be just like this market to confound everyone just when everything seems the greatest and it's all lining up for a Santa Claus rally. We get a coal in our stocking instead.
I'm generally someone that feels most comfortable when the intermarkets all align, and the fact that rates keep pressing higher, and the fact that the dollar is generally been strengthened, even though this week it's kind of off of its highs. We haven't seen a shift in any of the major intermarket asset classes from prevailing trends that have been in place for months, and really it's the equity market that turned alone. Now, it doesn't mean that the other markets can't suddenly pause these prevailing trends, but I would have felt much more confident about an S&P rally if we really saw all of those intermarkets kind of mean reverting or at least changing trend, and that's just not there. Do you put any importance to that, or?
It's one of those things. I really do believe that if everything was lined up and everything was perfect, that it would almost be a situation where you'd be having to sell on news. Like you'd have to be going the other way. To me, Patrick, there's always something that's not quite, confirming what is occurring, and the question is trying to figure out if it actually means anything this time.
Yeah. So number two was the central banks. We got 3 central bank meetings next week. The Bank of Canada might signal some rate hikes coming as the Canadian economy continues to do well over here. But then we have the ECB. Like, what's interesting is that will they push back against the speculation of early tightening? They're grappling obviously with that energy shock that's happening there, and they certainly aren't in the same position to be able to raise interest rates as some other countries in the world. It'll be interesting to see. And then, of course, Bank of Japan is going to come out with an outlook. Is there something you're watching, or you think how do you think this is going to play out?
Well, 2 of those, Bank of Japan and Europe, they're just complete gong shows when it comes to monetary policy. And I would argue that Europe would probably be better off with them raising rates and getting away from negative rates. But that's a story for another day. The bigger story to me is the fact that throughout the world, central banks around the globe are getting tighter. There has been a dramatic repricing of the front end everywhere you look. Australia, New Zealand, Canada, Brazil, all these places are pricing in increasingly hawkish central banks because they're worried that inflation has gotten too much. We're in this period where the front ends are getting just monkey hammered, and it's not stopping. And until we get into a point where it's more than priced in, it's just not one of these things you want to get in front of. So even though there is a lot of tightening priced into the, like, for example, the Bank of Canada curve, there's a lot of tightening priced in there. Some smart people are starting to look at it and say, hey, is there really going to be that many tightenings? It might not be, but I'm not so sure this is the point to step in and do it, because I think that we could get even worse before it gets better.
Makes sense. All right. So, and number one, let's talk about the fact that the belly of the earnings curve or the earnings reports are coming out. It seems like almost all the major ones all seem to report within a small window of time to each other. I mean, just to list some of the companies that are reporting next week, we've got like Visa, Samsung, MasterCard, Exxon Mobil, Shopify, Texas Instrument, McDonald's, Coca-Cola, Eli Lilly, Chevron, and that's all these energy names like that. And then, of course, the FANGs, Apple, Microsoft, and Google are all coming out. And so, so far, as these earnings have been coming out, I think that all of the adjusted expectations have already somewhat, the market's certainly not getting wobbly off of any of the earnings that have come out to date. It'll be interesting to see whether that trend continues, and maybe that actually drives a breakout. Who knows? Any thoughts on some of these earnings?
Well, I have the good pleasure of knowing this fellow on Twitter, Efficient Market Hype, and he shared with me a spreadsheet that he had created that looks back over the last 10, 12 years at this cycle and looks and seen if when you're along the reporting period, whether the companies have underperformed or outperformed in terms of how it's affected the market, meaning that during the cycle, at what point did the market go up or down? And over the last 12 years, if you take out 2008, because 2008 was kind of a weird year, on the whole, we had rallied up until this point, and we've actually entered into what would be typically the seasonally weak week or two of the reporting period. So I'm actually going to take the other side. I think we stumble a little here, and we grind lower going the next week or two.
Well, it is an interesting view, because let's be realistic. That market, the shoot up that we've seen in the last week and a half of upside on the market is a very overbought. And so on balance of probabilities, usually the rally being checked with some sort of a small kind of, I don't want to call it a correction because that implies a bigger percentage, but usually the rally pauses and you get 50 or 100 S&P point corrections that just kind of shake out the weak hands and create little buying opportunities. It would be natural to see one. It'd be interesting to see if these earnings drive some sort of a pause in that trend that's been so strong in the last 5 days.
Okay, so let's have what have you got for us when we're reviewing?
Yeah, let's look at the charts.
A lot's happened.
Well, yeah. Okay, I want to let's jump to those yields, because I thought it was really interesting what you were talking about. I want to just highlight. Let's look at the yields in the 2, 5s, 10s, and 30s, because I know that inflation and inflation expectations are rising, but it's interesting where the charts are moving the fastest. And when you look at this 2-year yield, while on a percentage basis, it's about 25 basis points up in a month. It's just on the chart. It just looks like the steepest and most accelerated move.
So 1 second, I gotta say, Patrick, never do that again. You never. We're not allowed to do that. We're going to be better than that. We're never going to put percentage changes to yields.
Thank you. I meant the number of basis points that went up. It
oh,
went
you
up
did.
To,
I'm sorry. I meant the 25 beeps as opposed to 25%.
Yeah. It moved up 25 beeps. Yes, okay. We're not saying percentage. Yes.
Yeah, because that's the
I understand. Yeah, exactly.
Guys go in and they say, "Look at this! Rates have doubled at the short end. They've gone from 10 basis points to 20."
It's like no.
Yeah, which means a lot different than going. From
but they did double.
To 400.
That would be the more accurate thing. They did go 100%. But no, just all joking aside, They did move about 25 basis
Beeps.
points.
Yeah, okay, so
on the upside. But
Yeah.
but what I want to highlight is the fact that the twos have the steepest acceleration from just the way the chart looks. The 5 years also moving very distinctly to higher levels than they traded in April and July. And then as you go farther out the curve from the middle of the belly all the way out, when we're going out to like the 10-year, which is approaching those highs, but not yet broken those first and second quarter highs. And then the 30 years lagging even more. So it's really almost like a flattener. Obviously, the Fed is still pinning the front, so you can't call it an outright flattener. But at least the belly of the curve is moving faster than the right tail.
Right. Well, what they've done is they can't. The Fed is committed to not raising rates until they get the taper out of the way.
Yeah.
So the taper is going to take till mid-22. So the front of the curve, the very extreme, up until middle of next summer, there's going to be no rate hikes priced in because the Fed has told you that they're not going to do that. So assuming you take the Fed at this word, then that's what's going to occur. So that's why you're seeing what you're seeing, because the market is assuming the next 9 months or 9 months or whatever it is, a little less, is going to look flat. And then we're going to get rate hikes. And what I think is interesting is the fact that they think that the Fed is going to hike quickly, and then the market or the economy is going to roll over.
Yeah.
Because they're not worried about the long end. As you rightfully point out, there is very little fear of long-term inflation expectations getting out of control.
Yeah.
But there is all sorts of fear about the Fed having to tap it down hard come next summer.
Right. And what is interesting, and by the way, so this is a great feature on Koifin, the charting software we're using right now. And Rob's just done a great job putting this together. And what I wanted to highlight was one of your favorites from a year or two ago, which I think you've changed your stance on. But just to really show it, when we're seeing these interest rates rising, intuitively you would think that there's this big steepener underway. But then you look at that 5s, 30s. And it looks like one of the most bearish charts out there.
100%. It's terrible. It's awful. And that's been the problem. And then what I think is shocking is how well the stock market is taking the fact that we're getting this flattening everywhere.
Well, but the interesting part is that do you think that the flattener matters most when it's the Fed moving the Fed funds rate, and that the flip happens when it's the Fed funds that overshoots and the market and it flattens it or inverts it? Or because right now, by it kind of flattening in the middle, but the Fed keeping the Fed funds rate still pinned at the bottom, the curve.
Oh, I
is
see
still
what you're saying. The fact that the very extreme front end is still
pinned down there.
Yeah.
I mean, do you think it has the same implications?
I think that really the yield curve is a good indicator, but the reality is that as we get more growth, depending on how the market believes it will evolve, it would be natural for the curve to flatten even in the face of good growth. Because if you think about it, if we got a situation where they thought that the inflation was higher but not going to be a problem, let's just say it was going to be 3%, 2 to 3%, you could see a situation where they assume that the Fed will have to tighten for a little while and slow everything down. But then what will occur is that they will keep inflation in control, and therefore longer dated stuff like 30 years, that an investor out that long has nothing to worry about.
Yeah.
Meaning that there's not going to be a period of 20 years of 5% plus inflation.
Right.
So to me, it's a function of increased growth and increased inflation over the short run that the market is confident that the Federal Reserve will be able to control. So that's how I interpret it. And don't forget as well that sometimes there are actors that have to invest and it doesn't matter what they actually think. Meaning that if you're a pension fund and you have liabilities to offset, you have to go buy bonds. And for example, I don't know if someone, a German pension fund that's buying, 30-year, I don't know what they're called. I can never remember. Bunds or...
Yeah.
Anyways, you don't know either, but
Sure.
but there's another name
Bunds.
for 30-year. There's like Boxel or something. I'm not sure what it is. So someone will let me know later. But if you're sitting there as a pension fund in Germany, I'm not sure that you actually believe what the prices are trading at, but you might have no choice but to
You have
buy.
no choice. Exactly.
So
I
it
hear
could
you.
be that some of these signals that we've long thought were great signals were when things were trading more freely. And it's a question about maybe we shouldn't be following the kind of longer dated yield curves as much as we thought. Anyways, just something
All
to
right.
think about.
Interesting. So what I wanted to just touch on was just that the prevailing dollar trend remains intact. I mean, look, the euro has bounced a little bit, but the euro's been just awful for the entire year. There was that little April rally, but overall systematic selling, dollar strength has continued, and really what will be interesting to see is as we bounce here, if all of these previous lows act as overhead resistance in the Fibonacci zones, like if the euro can't legitimately beat 117 on a sustained basis, that's a red flag that the dollar may still have another leg left in it. And it's something that I think is completely worth watching as we move forward. It'll be also interesting to watch like things like what the CAD does in the once the BOC talks about what's next when we get the meeting next week. Sorry, did you want,
Are you moving away from foreign exchange?
Yeah. Well, did you?
Okay,
Which one do you want to touch?
I want to say one quick thing about foreign exchange. I don't have an opinion about what the dollar is going to do.
Perfect. You don't have an opinion. Let's do it. All right.
No,
Okay.
I don't have an opinion about what the dollar is going to do next week, next year, like next month or whatever. But I do have a feeling that we are entering into a period where there is more divergent monetary and fiscal policies within different. Compared to one country to another.
Yeah.
And I suspect that foreign exchange has been extremely boring for a long, long time. I suspect that we will be talking more about it and there will be more opportunities in it going forward. And if I was a young trader looking for something to brush up on and start to watch for, I think that foreign exchange might be kind of something that returns to the macro community in the years ahead.
You know, it's interesting you say that because if you go back and look at the swings that the U.S. dollar has done back like 2 decades ago, back in the 90s and 2000s, there were extraordinary moves. They're talking like nearly a double on the dollar and then a 50% wipeout on the dollar.
Yeah.
And now when the dollar moves 5%, everyone is like,
right. Go watch that video of Paul Tudor Jones, like that video of the trader or whatever it's called.
Yeah.
Yes, he's trading crude oil and he's trading, stock index futures, but he's also trading gobs of foreign exchange. It used to be a big source of alpha. It used to be because think about George Soros.
You could lever it up.
Right, and George Soros, what is he famous for?
Yeah,
he's famous for the Bank of England. We haven't had a currency event that's been any fun, since like the Euro Swiss?
Yeah,
and even then, that was a very niche event.
And that was like a 5-minute event. Either you,
that's right.
It was like literally if you were in it or not. Like some people got zeroed, some other people things.
Like I remember when I was an institutional trader in the 90s, I always used to look at the guys that were trading foreign exchange and think it was the coolest job in the world because they used to have the central banks intervening in their currencies. And I always used to go and say, that'd be so much fun. Like get a call from the Bank of Japan and they go, where are you on 100 billion yen? And you got to show them a market. It's like kind of fun because, you're showing them like a dollar outside but everyone knows once they come, they're going to do everything. So how much does it have to move? Anyways, I used to think those were just the greatest, most exciting markets in the world. And I used to think, it'd be so great to be a foreign exchange trader. When was the last time someone, dreamt about being a foreign exchange trader?
Yeah.
And I suspect that's going to change in the next few years. Anyways,
there you go.
You hear,
that's
here first.
It's going to be a day of ranting from Kevin. All right, so the SLV, I just want to first highlight gold that creeped toward 1800, didn't beat it, or at least didn't beat it on a sustained basis. We're back underneath it. We prairie dogged it temporarily. But what's interesting is silver did a pattern which I love, which is a pattern where you create a V shape at the off of a low. So as a measured move finishes, when you have a rally that wipes out the entire last sell sequence, which was this drop right over here, that is often the first sign that a bottoming formation may be developing. And one of the things to watch for going into the month of November is at some point this rally will be checked. At some point we're going to find that the silver is going to drop a buck and a half, and some sort of a kind of pause and reversion. But if it stops making lower lows and the buyers buy the dip, that there's the classic patterns of inverted head and shoulders or double bottoms or other types of key bottom retest type patterns that start to emerge. And before I'm on the record of claiming that this is for certain money in the bank, what is certainly going to be something I think is going to be on the top of my watch list in going into the coming month for sure.
I don't want to comment in case I goocher it.
Okay, so next, natural gas. The interesting part I wanted to highlight here, I'm not going to goocher for you, so you don't have to comment.
No, you know what? I'm almost out of natural gas.
Oh, there you go. Perfect, because I think that this is an interesting buy on dip moment.
Okay.
And so the fact that you're flat is we're good.
Yeah,
so,
I've been selling for the past month. Like
you've been trimming it down. That's what is interesting here is this $5 handle down along here was a level where is my sort of line in the sand. It was for like S&P traders, the 4,400 level. To me, if Nat Gas can hold at 5 or above, it still has the opportunity to punch higher highs. Maybe we see 7, and under 5, I think the trade is over. And it's not that about knowing whether it will hold or not. It's a very asymmetric level. So you can put on the trade with a marginal amount of risk, because you can punt it very quickly for a small loss. And if you clip it after going through like a 2-week pullback, there's at least a reasonable upside for if it does manage to turn up. I like it here as an interesting to put your some skin in the game and seeing whether it can actually engage an upside turn.
Sounds good. What's your next one?
Well, you know what? I'm realizing that we're running like pretty thin. Let me just see if let's talk about Facebook.
We have a big hurdle to beat. You realize, because one of our listeners suggested that it's going to be an epic 4-hour show.
No, we're not going there. All right. So we need Cuppy and others to help us out to make it 4 hours. What's interesting is, did you see the gap lower on Facebook today? It's interesting. That's and what I find interesting is obviously Facebook has been had that big outage. Certainly no shortage of headlines in terms of the influence of social media, and Facebook is obviously the poster boy for the everyone to kind of attack social media. It is interesting that this drop here will it spark the beginning of another leg lower, and more importantly, does that result in selling in other FANG stocks? Because while the FANG index did punch much higher, and even Microsoft made a higher high, Apple's been sluggish, Amazon's not exactly in an uptrend. There's a lot of FANGs that are still muddling along, and it'll be interesting whether Facebook is the first one to break to a lower low in this sequence. The other one that I wanted to highlight was Elon Musk, and just the crushing of all the hopes and dreams of every Tesla short.
And you know what the most interesting part about this, Patrick, is that you and I both highlighted how strong it was. Now, neither one of us got long, and one of us are a complete idiot and just can't live without a small short on. The
only reason I'm not sure is because the October OPEX rolled me out.
But what's funny, so that was actually why it kept going up, because we highlighted how strong it was, and we remember we were talking about this. We were saying the market's looking weak during that whole month of last month. The whole market was looking weak, and this thing just kept grinding higher. It was telling you it was being accumulated, and you might hate Elon, you might think it's going to shit or whatever, but the reality is that the charts don't lie.
The charts don't lie. It's like when it's being bought, no matter what you think of Musk. Anyway, that's all I've got, Kev.
That's great.
All right, let's move on.
Okay, what do we got for this week in trading history, Patrick?
We're going back to October 22nd of 1857, and it was in the midst of the Panic of 1857. We've had similar stories about this period in the past, but let's circle back, because I thought there's some really interesting highlights to cover there. So the Panic of 1857 in the United States was caused by a declining international economy that overlaid into an overexpansion in the U.S. economy. Because of the invention of the telegraph in 1844, the Panic of 1857 was the first financial crisis to spread rapidly throughout the United States. And it's interesting that this is associated with Kev, because obviously the internet completely changed everything for us, because the dissemination of that information became almost instantaneous. But back then, before the telegraph, it would take days, if not weeks, for information to be moved around. And therefore, a simultaneous financial panic was not really easy to do, because people just couldn't communicate around the world. And this telegraph completely changed it. So this was the first kind of financial crisis that spread rapidly throughout the United States. Now, the world economy was also more interconnected by the 1850s, which made the Panic of 1857 the first worldwide economic crisis. So in Britain, the government circumvented the requirements of the 1844 Bank Charter Act, which required gold and silver reserves to back up the amount of money in circulation. The surfacing news of the circumvention set off the panic in Britain. In the 1850s had seen a booming U.S. economy. Railroads were rapidly expanding. The U.S. had grown its territory after the Mexican War, and gold was discovered in California. But by 1857, railroads were beginning to have a hard time paying their debts. Land prices were dropping as railroads slowed their expansion, and several banks began to fail. As depositors began trading their dollars in for gold, gold supply began to quickly diminish. And that just shows, a lot of the hard money problems, right, Kev? Like when you anchor off of gold and the money supply being anchored to it, when there are supply issues, then the response is these types of volatile economic events, right?
What doesn't kill you makes you stronger, Patrick. Don't you know?
So by October of 1857, many railroad shares were down 40%, including numerous bank failures. The situation was made far worse when the steamer Central America sank off the coast of Cape Hatteras on September 12th, along with a much-awaited shipment of gold from California, which New York banks needed to stay solvent. American banks did not recover until after the Civil War, after the failure of Ohio Life Insurance and Trust Company. The financial panic quickly spread as businesses began to fail. The railroad industry experienced financial declines, and hundreds of workers were laid off. Then the U.S. Treasury halts redemptions of paper of gold, which was known as the Western Blizzard Panic of 1857, was in full swing, and the loss of confidence caused additional panic around the world, spread everywhere from London to Paris. All markets sold off. It was quite the event back then, one of the first global events.
That's great, Patrick. All right, time for skin in the game, and I actually managed to win one.
Yes, you did. Not only did you win it, you won it instantaneously. like
didn't have time to put the poll out.
Yeah. It's like Sunday. I look at the machine and it's like, fuck me, right? Like
Did I literally win Sunday night?
I think it was by early Monday, but it was it just kept screaming higher. Just did not.
Why
quit.
don't you remind people what it was?
We were trading the yen, and
right.
we said the U.S. dollar yen to touch 113 and a quarter, and basically 113 and a quarter was this. Remember, this was done 2 weeks ago. Was what, like right here. And this green candle was basically how we started right out of the gate. Just like boom. It's like, oh, I'm gonna choose a very reasonable level that's at least like one standard deviation higher from its implied range. Is blah 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 gone. Just like it, just instantaneous egg on the face. You got me, buddy.
Okay.
I made the bet and fell on my own sword. It's
yeah, that's right. You're absolutely right. Okay, so
tell
let me tell
people
people
about
about the game. So, Skin in the Game is a weekly opportunity for us to demonstrate that we are degenerate gamblers at heart. Every week, one of us presents a wager. The other guy chooses which side of the bet he wants. Every wager needs to settle by next episodes, and everybody knows the currency. I won't say it again. The winner of the bet is obligated to create a new bet for the following week. So that's me. All wagers settle in full, and there will be no netting in positions. Okay, I've been thinking about this. We're going to take the lead Nat Gas contract. So what will that be? We need to contract it out.
Right now, the lead is still the November. Are you sure you want to do the November?
Okay, so we'll do December. Where is
Okay.
December right now?
All right, so let's take a quick look. All right, so the December is trading at 546. Now, we are recording while the market is still trading, so this is our starting point.
Okay, so 546. Okay, so this is what I'm going to do. I am going to we're going to trade a 545 straddle.
Oh, I like it.
And so now it's a European straddle. You
All
can't exercise it early. Okay, and so it's European, so it's only going to be based upon the close of next Fridays.
All right.
Okay, and so we have to figure out. I'm going to give you a level, and then you can buy or sell that straddle.
Go for it.
Okay, now.
You got your Bloomberg there to
I
go
don't,
price this?
unfortunately. I'm up. I had to get a.
So you're pulling shit out of your ass.
I am pulling shit out of my ass. I'm trying to figure out how to price this and figuring out where you're going to be. And so I'm going to say, 545.
Yeah.
I am going to say the straddle. I'm going to say 44 cents. Buy or sell.
Okay, so just clarify. So we are going that it needs to be 44 cents higher or lower.
No, that's too high. I'm going to go 40 cents. So you're going to, you have to buy.
It's got to be outside of the range.
Yes.
So basically, we're going 585 on the upside, down to 505.
Yeah, so you can.
So basically, do I think it's going to stay in the pocket?
Yeah. So I think 40 cents is about the right. Let me just look at this again. Let me think about this. 1 week.
No, you just called it. I know.
Okay, 40 cents. We're staying with 40 cents. Buy or sell.
God, I'm going to stay with the short side of this. I'm going to say it's going to be in the pocket.
You're selling this 40 cents.
I'm selling the straddle. Yeah.
Okay, you and optionsellers.com.
Hopefully I don't have to lose my Rolex watch in this bet.
That's right. When you lose, you got to get on there and tell everyone why you lost.
I'll make a YouTube video with my Rolex watch.
Note to hedge fund manager: when you blow up your clients, make sure you do not
take off the Rolex when you're making the video.
$40,000 Rolex before giving your apology video. Pro tip.
All right, what's the bet, buddy?
A burger. I'm hungry.
All
these
right.
days.
Okay. You know what? You just got yourself a burger. Now you're going to double down. What will be good is if I clip
Moose
you
burger.
on this one. No, but I could give you the moose burger for sure. But what we can do is if I win, we can go for burgers and pay for each other's burgers.
Okay, that is true. That doesn't seem quite right, though.
No, it does not actually.
That doesn't seem right. That seems like we're netting positions.
Yeah, actually, that is a net. That's not.
Yeah,
I take that back.
Yeah, that seems wrong.
Okay. All right.
Okay.
So it's time for Lena to jump on because we're going to do some no stupid questions, and we've got a few of them. So Lena, how you doing?
I'm doing great. Just listening to you guys banter.
Oh, that's what that is, eh? All right. All right. Let's do this. What's the first question?
The first question this week. As vets of the psychological warfare known as trading, how do you guys deal with the emotions that come with trading? The pain, regret, annoyance, FOMO, envy, saltiness, frustration, feeling stupid, Schadenfreude? Is that how you say it? Etc.
Schadenfreude.
Schadenfreude.
I think. I don't know.
We don't know how to pronounce things on this podcast.
It is the Market Huddle.
So thanks for all you do.
I mean,
so
Kev,
wait, I only have one answer, and it's beer.
So this was supposed to be no stupid questions, just stupid answers, and you gave the perfect stupid answer. All right. So
well, no, we should talk about it.
I will. But the key here is, in my mind, and we talk about this in so many different programs at Big Picture Trading. But the one thing that I always highlight, you have to go into every trade with a plan and trade the plan. And what you have to do is not focus on what everyone else is doing and whatever everyone else is making, but focus on your trades at hand and executing what you got to sleep in the bed you made for yourself. It's like you have to just execute on what you've put on. And the thing is the more you look at everything, and I mean, if you were looking for a certain profit over a certain amount of time and you made a good risk reward proposition, you got the asymmetry in it. If the thing keeps going, so what? You've made the trade and you executed it right. You have to get over the fact that the market has a certain amount of volatility, and you can always have that regret and the FOMO of doing things, but that's not how you trade professionally, right?
Completely agree. And the other thing, the little piece of advice I give is that don't let the highs get too much, because if you let the highs get too much, then the lows will also be the corresponding kind of reciprocal of that. So the reality is that you need to treat it like a job. Yeah. And when you start treating it like a job, you'll realize that it's just part of what, what happens. And one of the other kind of interesting ways to think about it is think about your job as a trader or a professional investor as like a casino. Yeah. A casino sits there and takes bets all day and just realizes that over the long run, they have an edge and that they're going to exploit it and they're going to be up. And they don't worry if one person at one point, goes on a run and they lose a little bit more. They know over the long run that it's going to work. And so that's how we as professional traders view it.
Yeah, for sure.
So hopefully that helps.
Yeah. So Lena, what's the next one?
So the next question here, actually quite a stupid question. For an everyday investor who doesn't have access to futures market outright, how do we get involved in the commodity, quote unquote, great cycle efficiently? And what are the biggest caveat that you think would get the most of retail investors? A few easy thoughts on my part. Easy mistake of getting on consumer staples and not realizing they're more likely the victim of the commodity inflation instead of benefiting from it. Great burn of fees and roll costs of investing in ETFs of the sorts. I hope having a better understanding this would benefit the general public and in turn the market. Cheers.
So Kev, I mean, I'm sure you'll have some insights on this too, but I don't necessarily think that you have a huge edge by going directly into the futures market versus not. I mean, the one thing the futures market offers is a great way to leverage if you're seeking leverage for that purpose. But I mean, the correlation of many commodity equities is there to the underlying commodities. And as well, there are a number of ETFs that are rolling the futures inside them. So there are plenty of ways to have skin in the game that doesn't involve you having to open a futures trading account. Obviously, that's the most purest way of getting the direct trade on for the commodity, but there are alternatives out there.
Yeah, there's a variety of different ones, but I think that this listener was meaning that there was more than that, because you started talking about the consumer staples, and owning a consumer staples ETF is much different than owning like a commodity ETF. And in terms of getting involved with the commodity great cycle, that's difficult as well, because who knows what parts are going to go. And one of the things that you need to think about is that a lot of these commodity ETFs are weighted very highly in one specific commodity. For example, a lot of them are stuffed full of oil. And if you buy one with lots of oil, it's going to behave a lot different than if you buy one that's more of an industrial commodity base. And so it's not something that's easily answered in terms of coming up with a nice, simple conclusion, that go buy this. There is no answer to that. The reality is that keep doing some work, come across different things, diversify into different commodity ETFs, watch how they behave, and try to figure out what the underlying asset is, and pay a big attention to fees. That's for sure one of the biggest issues out there. You don't want to be long something that's thin and with big fees.
You know, what's interesting is one of the issues for tracking purposes that was always an issue with the ETFs was the contango roll, but that occurs in rolling up the curve. But realistically, futures traders have to deal with that directly anyway.
That's true,
right? Like they're rolling into it, but they have to actually manage the roll themselves. But they're suffering the same roll consequence of doing so, and so everyone that's beating them up saying that the ETFs have this issue. Well, if you're rolling the nat gas curve, you've experienced plenty of slippage on that and the carry that's associated with it.
It's just like all the people that want to be long vol, but they don't want to have the negative carry.
Yeah.
Being long vol means that you get negative carry. It just kind of comes with the whole.
What is interesting though, there's been some flattening and backwardation in that in a lot of these commodities. So some of these ETFs are actually able to they use the DJP, which is that Bloomberg Commodity Index ETF. Again, DJP, it's something like that will have has far less of a carry today than it did a year ago.
And if I may suggest a certain other podcast that my partner cheats on me with, that you had a great guest on there. Is it Ole? Is that how I say it? From Saxo Bank.
Yeah.
A terrific episode. Go back and listen to that. Go have a look at the stuff that they do, because there's some terrific stuff. And as Patrick rightly highlighted, some of these negative carries have actually turned into positive.
Right. All right, Lena, what's the next one?
Next question, Lena and Gents. Like perhaps many of your listeners, I've done well on the uranium trade and want to exit before my yellow laser beam eyes dim below their ability to cause cellular death. What should I do? Shout "Tanbagger" in my best cuppy imitation until someone says something dumb on an earnings call and then sell instantly? Average out? Do something fancy with options or crayons or both? Tell myself it's a multi-year trend but do no research and just hodl? How do you think about such a situation? Love y'all. Thanks.
Okay, so before we say anything, we're going to tell you what we would do and some things to think about, but we're not giving investment advice. This is, you ultimately should, all the disclaimers, go talk to a financial professional about your specific investment situation. Having said that, Patrick, a customer or client that's dealing with this, what are some of the things that they might think about?
Right. Well, first of all, this is always about the bigger picture versus the shorter time frame. And that's always the struggle is that we're trying to match time frames. I mean, some uranium trend could last years, and hodling it might actually be the best long-term thing to do. But just as an example of what happened a month or two ago, where we had the huge pop and then the fade, sometimes you get completely overshot, and as a trader, it behooves you not to do some sort of an action to lock it in. I love collaring things in. I sometimes sell some. I've done a trade where I've sold my underlying and rolled it into a debit spread, so that way I have a limited, continue to participate, but have a limited capital outlay and risk. There's different strategies to do. The key is that the one trap that the average retail trader falls into is believing paper profits are real profits. And then once they've seen the high and they no longer can sell at the number which they saw their account value at before, they can't sell. And then they give everything back as it all mean reverts. I'm not trying to predict that for uranium, but I think you just need to have some sort of a strategy that prevents you from going through that.
Well, that's true. And the other way that I like to think about it, which is kind of similar but different than your way of thinking about it, is that I ask myself, am I in an emotional frame of mind? Whereas if I get a typical or expected or normal reaction, that I will be able to do the right thing without panicking. So, for example, if you're sitting there and you're thinking about how much money you made and everything, and then all of a sudden the thing corrects 25%, but you look at it, it corrects 25% all the time, and that you should be expected, yet you can't handle the emotional part of it, and you end up puking out at the lows, that's what you want to avoid. So I always ask myself when I'm in a position, do I have the mental, am I in the right mental frame of mind to be able to sit through a normal correction? And the moment that I don't feel that I am, I start reducing position size.
That's that. There you go.
And the other thing, sorry, go ahead.
That's
Patrick.
just a rebalancing. Like, so if you've doubled and you go back to an equal weighting of what you had on your original position, you're still carrying the same size of position as before, but you've taken some off the table. Like, just going through an exercise of rebalancing the weighting of it in your account is in itself a very good exercise, right?
100%. Like, for example, I know somebody that recently nailed the DWAC trade in size, and the advice I was giving was, I was saying, be aware that you have become accustomed to a vol, an amount of volatility in your portfolio that's much higher. Reset yourself back to the lower volatility. Because if you get a situation where you get this big, huge win, and let's just say your typical account, you're used to going up. Let's just use super small numbers so that we don't scare anyone here. We'll just say, let's say you're used to going up $1,000, and all of a sudden you make $10,000. You might think, woo, you know what? Now I can start trading bigger and things like that. The reality is that you had a kind of
you got lucky.
You got lucky, and you should, yes, maybe eventually you should increase your position size, but you shouldn't do it just because of that one thing, because that your actual risk return profile hasn't changed just because you got lucky on the one trade. Anyways, and the one last thing I'll tell you is that when we had errors on the desk, and a lot of times when people get errors, they don't think straight, and we always used to say, have it. And if you're still not thinking straight, have it again. And if you're still not thinking straight, have it again. So in some ways you might say, well, if you're nervous about it, have it. See how you feel then. If you're still not feeling good and you feel like you might have too much, have it again. Anyways, all of these things are just things to think about. I think really, though, Patrick's main original point, which is to have a plan, is the best one. Whatever your plan is, figure it out, write it down, and follow it.
You can always hold it right, some of it right to the very end, but you have to take some sort of actions along the way to ensure that you don't give it back. Yeah. That's just the key. Anyway, Lena, the last question.
Last question here. Hi, Lena. Congratulations. Thank you.
Yeah, congratulations. Okay.
Very excited for you and Luke and your new marriage together. Pro tip for Luke, send around your registry to the Market Huddle listeners so he doesn't have to buy that $1,000 Williams-Sonoma egg pan at some future date. I've been there. I feel your pain. Stay strong, brother. I don't think he's listening to this, so that's good for me. This is my second stupid question to the Market Huddle, so that probably means I have learned nothing from the CFA curriculum, or maybe you forgot everything if you haven't paid dues. Shh. My stupid question for Patrick and Kevin is, I've been selling 1 to 3 month covered calls on my positions 10 to 20% higher near the crayon resistance lines. Specifically, I sell Bitcoin calls. LedgerX Exchange tells you to sell to 0.01 Bitcoin, but keep getting called away as the asset that shall not be named keeps going higher. Other than knowing what dealers feel like when getting royally Tesla squeezed, the calls have been detrimental to my returns, and my friends just call me a paper-handed boomer, which hurts my millennial psyche.
This is a millennial, the worst thing they can be called is a paper-handed boomer. I love it.
At what point do you buy more of the underlying if you're still bullish the underlying? Do you buy back when it gets near the strike price or on the way up? Basically, what is your strategy for writing covered calls, and how do I stop feeling like a fool when it runs away from me? Any strategy is helpful. Much appreciated. Anytime you're in London, would love to grab a pint.
All right.
That's a great question. I love that. That's my favorite question in a long time.
Yeah.
Paper-handed boomer is I'm adopting that.
So the first thing that I think is that this exemplifies someone that's crossing streams. First of all, like the way that if you're first of all, let's talk about the asset that shall not be named. Do you own it as a currency? Do you own it as a hedge against inflation? Do you own it because you believe that it's going to, quadruple in the next number of years? Forget about our opinion. We're just like, there's an intention behind it. The thing is that once someone enters the world of option writing, you're entering a world where you're focusing on a different style of absolute returns, which is that you're seeking to harvest a cash flow from an asset that is different than one's position as to what they believe that underlying asset will do over time. The biggest problem that people have is they want to be bullish something. They take their absolute favorite, most bullish thing, and they sell covered calls on it, which I think is it creates a lot of cognitive dissonance in someone's mind in terms of how they're dealing with it. Bottom line is, if you're bullish Bitcoin, why the hell are you writing covered calls on it? Like the way I look at it is that when I'm option writing, what I'm option writing on, I couldn't give a shit about the asset because I'm going to lose it at some point and or have to trade away through it. The way I'm looking at it is I'm trying to harvest an X amount of premium that's going to have me make an income at the end of the day. And so when my little rant on this is that either you're an income writer or you're a Bitcoin investor. You shouldn't try to be earning an income on something that you're bullish on this way. Like, so that's my sense. What's your take on that?
I think that's a great take. I would be a little more nuanced. I would say that if you thought that the vol was extremely overpriced on the asset, you could end up...
Says the guy that has naked calls written on fucking Bitcoin. You're such a... like, go on.
No, but I kind of do see I think you have a very valid point, and I do think that is
that you're naked the calls.
No, that is what the listener is struggling with. Is the fact is that he's getting upset that he's getting called away, and yet the thing's ripping higher. The reality is that the volatility and the rally in this thing was just abnormally large. And so to me, that strategy is going to underperform in a monster rally. And that's what you just have to learn to accept. And one of the ways you could do it is you could just... But you
just made my point. Is the strategy to harvest premium, or is there a strategy to be bullish Bitcoin?
But he could have also figured out the delta and given himself an option like a delta hedging strategy, and chosen to hedge it at a certain delta.
It's a covered call. He owns the underlying. Is selling
I understand,
premium
but don't
you're going to hedge a hedge, or hedge an income.
No, but you could say when you put it on, let's say, and it also depends on what he's selling, right? Like if he's buying the Bitcoin at 50,000 and selling the 51s, that's not going to work. That's a much different strategy. But let's say he's buying the 50 and he's selling a 1 month 60, like something that's like a 60,000, just trying to pick something up. And then the trouble is that it's rallying so hard that he's getting called away. You could say, okay, I'm going to do this, but I'm going to make sure that my delta never goes under this amount because I always want to be long. And there's lots of ways that you can do it from that way. But the trouble is those things involved delta hedging and option trading. And at that moment, you become more than just somebody that's doing a covered call. You're becoming an option trader. So that's back to Patrick's point: is are you an option trader? Are you a covered call writer, or are you a Bitcoin holder? Anyways, I think though this question is hodler. This question is a perfect example of the sentiment right now that the listener is complaining because it's getting called away on because it's such a long rally.
There you go, Lena.
Yes.
We have to cut off Kevin quickly here. No, there you go. So,
if
people have questions.
If we have people into all sorts of trouble from the Bitcoiners.
So,
if you have any questions for Kevin and Patrick, please submit your questions to nostupidquestions@markethuddle.com.
So, okay, now a week ago, Kevin says, I got a rant for this show. But after a couple hours into this episode, I'm like, I've heard about 5 rants so far. I mean, did you already cover the rant, or you got an additional rant? Because you're not okay. So Kevin is not done ranting. Okay, all right, here we go. I'm literally gonna watch my stopwatch. Here we go. Okay. I'm timing this.
Patrick, I'm mad. So
okay, you're mad.
I was going to go and I was going to rant on Twitter, and then I thought, you know what? There's so much I want to rant about that I'm going to have to write it down, and we're going to do this. Okay, so here we go. It's time for one of the Kev's rants. This one was sparked by a recent CNBC Twitter controversy. I'm sure everyone's seen it. But the reality is that what I'm upset about is kind of been simmering below the surface, kind of like your VCR light flashing over and over again. It's been there for a long, long time. For those who don't know, last week there was a former market wizard who, when he was appearing on CNBC, he seemed stumped when the interviewer asked him what the company he was recommending did. Okay. Patrick, you do interviews, I do interviews. I know after doing a bunch of them, I've had my share of bad ones. So actually, I feel for the guy. But regardless of whether he knew what the company did or not, or whether he actually faked the audio problems to answer the questions, doesn't really matter. That's not what I'm upset about. I don't care about that. Nor do I care when he had got his wife to videotape him in his stupid Lamborghini or whatever it was, and while he gave everyone the fingers and said to the trolls, right? The reality is that this guy would have been way better off had he said, not sure what it does, but the chart looks friggin' fantastic. Like, if you think about it, that guy would have been in the FinTwit Hall of Fame for that comment, okay? So anyways, I saw this guy, and he was just, like, spontaneously combusting. And going after him seemed, like, almost unsporting. He seemed obviously insecure, lashing out. So I thought to myself, yeah, this guy with his fancy car doing this shit, huge douchebag move. But, I'm a former Bay Street institutional derivatives trader. Some fool with his money trying to make himself seem better by flashing a fancy car. If I use that criteria and choosing who I hang out with, I'd have to dump half my friends. And who knows, I might even have to kind of get rid of that guy who stares at me in the mirror every morning. So anyways, I thought it was fair game to go after this doofus. So I'm not really judging anyone who went after him, because a lot of people did. But I didn't bother because he seemed to be trading on tilt. It just kept getting worse and worse. He's using lines like, oh yeah, well, my tax return says otherwise. Note to younger guys out there, when you start demanding respect by bragging about your income, it's like responding to small penis jokes that all guys make to one another. You've already lost. It was shocking to me that some 60-year-old trader slipped into this juvenile death spin, okay? And I'm sure at this point he regrets his decision, okay? So if I'm not, I didn't get involved, I'm not that fussed about what he did, why am I making this rant, okay? Well, during one of his mad ravings, he responded to quite a calm tweet counseling that he was making the situation worse by asking if the other guy had a certain female body part. Now, I can already hear groans from the crew who think that the world has gotten too politically correct. But let me ask you this. If instead of insinuating that the other fellow was a woman, he had chose to ask if he was a racial minority, what would you say then? Can you imagine it? And the reality is you can't, because it's become socially unacceptable to single out individuals for their race, their color of their skin, or religion. So why do so many people feel that they can do it based on gender? I am so sick and tired because I've watched so many women get on financial Twitter and get attacked in the most misogynistic ways imaginable. As many of you know, I was early on learning about MMT because the theory helped explain much of the financial plumbing. I've watched as one of those leaders of the MMT movement, Professor Stephanie Kelton, get attacked in the most chauvinistic ways imaginable. Recently, there's a young female financial letter writer that had to close her Twitter account, because a very senior, previously accomplished trader kept harassing her on Twitter. Now, I get it. There's plenty of assholes on Twitter, so women do not have a monopoly of getting abused on there by any means. However, I'm so fucking sick of society looking the other way when it comes to abusive, powerful men. I try hard to avoid politics on our show and in my Twitter feed, so I'm going to use both a Democrat and Republican example to make my point. Let's start with the Dems. I know that many people love using Monica Lewinsky as a punchline, but have you ever stopped to think about what a creep Bill Clinton is? Here he was, the most powerful person on earth, and what does he choose to do with his power? He takes advantage of a vulnerable young woman. Now, you might say Monica was an adult who was an equal participant, but come on, really? Do you really believe that? Most successful older men have had opportunities with younger women, but most don't do it because they know better. And even don't get me even started about Hillary. What she did to Monica was shameful. The Clintons and the Democrat machine threw Monica under the bus for the sake of Bill's career. I guess it was all in the name of the greater good, but to me, it's inexcusable. And then the Republicans. Do I really need to say anything more than grab them by the pussy? These men are monsters, and we are all complicit by not standing up and saying this behavior is unacceptable. Some of you that follow me on Twitter will recognize that I retweet a lot of Ben Hunt and Rudy von Havenstein's material when it comes to this subject. Rudy has asked numerous times for a certain former Treasury Secretary who loves being interviewed on CNBC and Bloomberg to be questioned about his relationship with Jeffrey Epstein. Yet when it comes to this subject, crickets from the big TV stations. And do you know what the message that our silence sends? Lest you think this, we are somehow immune to this behavior up here in Canada, let me dispel you of that notion. The other day, in a truly sickening act, a boy or a group of boys drugged almost 50 women at a Canadian university. I won't bother saying which one because the truth of the matter is it could have been anyone. The problem is not limited to one university. Now, the idea that you need to drug a girl to get laid is beyond comprehension, but somehow this has become normal enough that it happens all the fucking time. Guys, go ask your female friends. They will all have stories about them or their friends getting drugged. I was giving my teenage heading to university son a lecture the other day. I told him that when he sees this, that is not good enough to not participate. It's his duty to stop it. Go get help. Go call the police. Whatever the fuck it is, stop it. And so when numbnuts Lambo trader that got embarrassed by his CNBC error made his misogynistic comment, I realized that I can't tell my son to behave one way and then fail to do it myself. So I struck back in my own fashion, I highlighting the tweet and bringing it to everyone's attention. I guess I could have explained to him that it's not socially acceptable and asked him why he wouldn't say that in front of his mom or wife or daughters. Why is it appropriate here? But this is Twitter, so I made some snarky remark and released the hounds. Some of my followers remarked that we were fools retweeting all of his stupid comments and watching his stupid Lambo video. And sure enough, he was bragging how the trolls were increasing his subscription service. I can't control what people do. If people think that a 60-year-old man in a Lambo is worth following, so be it. It's a free country. Yet I can tell you this, after his misogynistic comment, I immediately unfollowed him. And when I highlighted his misogynistic tweet, I expected to get blocked, but shockingly, I haven't yet. But here is the important part. His video of the Lambo and bragging about the size of his tax return are still up in their full glory. But do you know what he took down? What he erased, but that is never really erased? Yep, the tweet about the vagina. This Saturday afternoon cartoon trader realized that enough of us weren't going to put up with that sort of nonsense. I can't fix this world. All I can do is behave in a way that I think is moral. And no, I am not perfect. No way. I am a 50-year-old white man, last I checked, who has worked in the finance industry my whole life. I admit I have been far from perfect. I will admit I still get shit about pronouns all the time from my wife and daughters. I try, but I'm not sure I'm ever going to get it. Okay? Yet the pronouns are the least of our worries. How about we start treating women like human beings? Have you ever asked female Twitter users what sort of stuff they get subjected to? It's shocking and creeping and pathetic and embarrassing to the male gender. Whoever thought so many men thought that they were Anthony Weiner? Personally, I am sick of these misogynistic bozos ruining it for the rest of us decent guys who, while far from perfect, are at least trying to make the world a better place for all people, not just men. Yeah, there are worse guys out there than Lambo Larry, but let's make sure these idiots know that the decent men aren't going to stand by and let this sort of behavior stand. When you see behavior that is not as acceptable, it is our duty to stand up and say something. Let's make finance a place where women aren't subjected to truly abhorrent behavior. Some of you might be saying, there are lots of finance women that don't complain. Yeah, there are some trader women who put up with this shit in my day too, but that doesn't make it right. You might think this is too much political correctness, but given the amount of dick pics these women receive, I think we can err on the side of being a little too strict until we even things out. Men, let's not put up with this unacceptable behavior more. Like I counseled my son, when you see something not right, do something about it. That applies on Twitter as well. I'm fed up with this not being a place where I can tell my daughter she would be welcome as any other boy.
Oh,
Rant over.
there we go. Well done. Well done. Oh, and you kept it under 10 minutes.
Did I?
Yeah. It was 9 minutes and 58 seconds. But actually, well taken though. It's a good point, and it does resonate with me as well.
Okay. Thanks for tuning into the Market Huddle. We appreciate you spending some time with us. Please give us a follow at the Market Huddle. We're there on Twitter every day. Give Lena a shout out. She gets tired of talking to Patrick and myself. You can listen to the Market Huddle on all the networks: Google Podcasts, Podbean, Spotify, Android Play, iTunes, and YouTube. A lot of people watch on YouTube to see all of our charts and visuals. And while you're there, please like and subscribe to get our latest content. And please, if you could, rate and review us on iTunes. Patrick, where can they find you?
You can find me at bigpicturetrading.com or follow me on Twitter at Patrick Ceresna and Kev. Where can they hear you rant on a regular basis, but in the financial written form?
Kevin Muir on Twitter, or you can follow my newsletter at macrotourist.com. And listen, we can never have too many friends. Bear market, bull market. We're just happy to spend some time together on this crazy ride. So thanks for tuning in. Now stick around for the after show. Okay, Patrick, you and I doing the beers here today.
Well, Lena, you didn't get this one?
No, I didn't.
No, Lena didn't get this one.
I'm on a bit of a cleanse after the wedding.
Yeah.
Oh my God! All right. Okay, so it was fantastic.
Yes. Pupper's beer.
This is a winner. This is like honestly a good beer.
It's getting the 10. I don't care. I know that's a
a 10.
It's an
You're
amateur
saying
call.
they could not have done better.
Just
Yeah.
a
This
tiny
like-
bit
It's
biased,
puppers.
but
It's
okay.
puppers. It's outstanding.
Oh, I can't condone this. Now you're gonna get me ranting. The 10 should never be given out under any circumstances. You've rated.
Pupper's beer is a 10. I don't care. It's a perfect beer. It's a perfect Canadian beer for a perfect Canadian show.
My God, I
giving
almost want to.
You got to be honest.
I want
to
to abstain from giving a vote because
I've
I'm in
soiled the
you
sanctimony
protest.
of-
Yeah, absolutely. Like, how will anyone ever respect our beer ratings when you
They
do
shouldn't.
something so absurd
But
like
that's
this?
the answer, is that they shouldn't.
I don't think they ever did anyways.
Exactly. So give us what you think it is. Honestly,
Well,
Patrick, what do you think it is?
With a 7.5. Okay, first of all, there is nothing outright unique about the beer because it is it's just a pure lager, but it's an incredibly well done lager. And because of that, if the average beer is a 7.5, which is my midpoint for an average beer, I'm going to give it an 8.5. And if it was rated purely lager for lager, I would give it a 9.5.
That's good. I'm
Right?
sure
Like,
the
is there-
people will be very happy with that.
Right, because there's a whole bunch of beers, and you don't want to just take a lager up to too high of a score against the whole universe. But lager for lager, it's a really well done one. Like, I really did enjoy it.
Everyone respects your integrity, whereas mine, they just like.
Oh no,
falling right off.
you've lost. What is that? What is that kind of a score? That is.
It's
Yeah, I
amateur
hope
stuff.
that never
It's
happens
amateur.
again. I like. Please, no more amateur.
Well, it couldn't
No,
happen
you
again because
like people are just not going to care. Can you?
He's giving out like a Letterkenny kind of score.
Exactly. Outstanding. 2-ply.
I'm not
10-ply. 10-ply.
10-ply.
I should have said that. I should have said instead of it as a 10, it's a 10.
All right.
I got
all
to
right.
watch the whole series again. You still haven't watched it, have you, Patrick?
No, I've been chipping away at one here and there, but I don't really watch TV, and especially now that hockey's back on. By the way, I'm going to go right now. We recorded a little early. I'm going to the Leafs game. Leafs San Jose, buddy. It's my first Leafs game in freaking years because of this COVID shit. It's gonna be nice to be out in the arena and putting back some beers and having a good time.
I got asked to go out for like an institutional dinner the other night by a former guest. We won't say which one, but who I appreciate very much. And it was actually kind of weird. And everyone was there going, "Is this your first time out?" I felt like we were all like...
Let out of a
like,
cage.
yeah, it's my first time out. It was like everyone was there. Like most people had, like the occasional one had been like, "Oh, I went out to a dinner last week or whatever." So it seems to be that Toronto is slowly coming back. The dinners are starting.
All the Floridians and Texas people right now are like, what
Like,
the
what
fuck
the
you
fuck?
talking about?
What the hell? I actually saw that there was some right-wing political host that was trying to organize that they were going to free Australia. Don't even get me started.
Yeah, let's not do that. Let's not.
Did you notice how I picked on both sides there?
Yeah,
I did
yeah.
not choose sides because misogyny goes on both sides.
Yeah.
Check and check.
Yeah.
So have any of you guys gone to see the movie? I just did something that I haven't done in 3 years. I went to the movie theater, but I went back to back 2 weeks in a row. I went to see James Bond, and I went to see the Dune movie.
Oh my God!
on the
Don't give me
opening
any
night.
spoilers.
I'm not going to give you spoilers, but
This is funny.
but
Somehow
like,
Patrick's.
I know,
everyone
no, but
else-
listen.
Everyone else is going to less movies. Patrick's going to more.
What do you
over
mean?
here.
I actually haven't, like, even before COVID, I went like maybe 2-3 years going to the movie theater just once. Like, so it,
I know,
like,
that's what I'm
it is
saying.
incredibly rare for this. But I already shared with how much I was looking forward to the Dune movie, and I had to see the Bond movie.
Yeah.
And so
Do you
so
go to the
like,
VIP theaters, or you just do the regular?
I
ones?
did the VIP for the Bond movie.
And are you just like a drunk mess by the end?
No, I just have one beer to just sip and watch. Like, I'm not going to
that's-
overpay for beers and then fall asleep in the middle
Oh,
of the
you
movie.
have your standards, do you?
Absolutely. Absolutely. Lena, what have you been watching?
You wouldn't fall asleep in a movie theater. You'd be like, "Come on, guys,
come
let's get
on.
the party going."
No way. Forget that. Like, if I'm sitting there drinking beer and staring at a screen, like, I'll be gone in 10 minutes. Like, I need to be up and triple
So-
peeing people.
Do you remember when you used to, like, when you took kids to the go see like younger kids shows? I slept through every single one of them.
Wow.
Fair enough.
Like I would go
That's a
and
talent.
the Tooth Fairy, I remember getting there, shutting her down basically 10 minutes in and watching The Rock, and then my son waking me up when it was time to go. That's basically all the movies.
amazing.
I'm just the sleeping parental unit.
My son's 4 and he's wandering out to go to the bathroom by himself.
Oh my God.
No, I'm just kidding. That didn't happen.
That didn't happen, I swear. I swear it.
Yeah, no way that happened.
Lena, did you...
imagine my wife, I'm sorry. I gotta tell a quick story.
All right.
So one time we were in the Bahamas at Atlantis, and I was there, and our middle child got really sick, and we were going out with another family, and literally my wife had to stay home with the middle one, and I had my youngest one, who's a little bit of a handful, and I don't know, he's like 3 or 4, something like that. We get out, I'm chatting too much as usual, and he disappears, and then everyone's like, where is he? And we're trying to find him. And you know, like when you go and at first you're like, oh, he'll show up. And then there's this moment where you're like 2 minutes into the search and you're like,
What
oh
if?
my God.
He's gone.
And you don't know true fear until that happens to you. And then it was literally another like 3 minutes before we found him. The little bugger had like really wandered away. But that is, my wife has never forgiven me for that, and rightfully so.
She brings it up every fight, right?
That's right. Anyways, Lena,
the
what are you watching these days?
the scorecards that are kept in marriage.
Yeah.
It's by a not. I'm not going to comment about which.
Lena,
which,
you got to get yours going now.
Oh, I already have it going. It's okay.
Oh, you do?
Oh,
I
yeah.
didn't realize that they started before marriage.
these things
Someone should have given me that.
accumulate. You know.
Oh, so you've got your list, right?
I've got
like
my
a little.
already.
It's a little black book of everything that's
all up
ever.
in my head. Nobody can see it. I just know.
That's
You know,
it's
one time-
dangerous. It's dangerous. Like, you know what? I'm like the perfect person to have a relationship with because I have a fish brain memory, and like basically. You do something wrong a week earlier, it's like you got a clean slate the next week. There's like there's
Patrick,
no
That's
issue.
just- that's called being male.
Yeah.
Like we all are like that.
Women
like, this
remember
is kind of like
everything.
whatever, and then they seem to remember every tiny little thing. After me going on about misogyny, and now we're
Yeah, I was about to say, like,
But
you know,
it's
like
true.
It's okay,
Women
listen.
remember
I actu-
everything.
Okay,
Don't
listen.
let them
And this
convince
is one
you
of my-
otherwise.
it's a scorecard.
I actually want to make a quick point about this. I don't think there's anything wrong with joking about stuff. I am not some prude that thinks that you shouldn't joke about stuff, but there's lots of guys who don't know where the fucking line is. And they're just miserable fucks. And I've just had it with these miserable fucks, and I just want them off the thing, and I think we got to start telling them, no, you're miserable fucks that need to be gone.
Yeah, okay.
Anyway, so that was...
Lena, what are you watching?
I haven't actually watched anything.
Yeah,
I'm
you're
waiting
in
to go
the
see the
post
Bond
here.
movie, Dune, and I was going to watch Succession, the new season, but I figured I'll let a few episodes accumulate so I can kind of binge in one weekend.
Oh, I heard it was really good. I didn't watch it.
I'm
but
sure it was. I
I
couldn't
heard
bring
it was
myself
really
to just
good.
watch
People seem
one
to be
episode
really
and
liking
wait.
it.
Yeah, so I might go back and watch the first 2 just so that I can get caught up again.
Like the first 2 seasons?
Yeah.
You would do something that extreme?
That's
Like
not
I once
extreme.
thought about the idea of going back and rewatching Game of Thrones, and then I realized how many episodes there are, and like, no, I don't think I'm going to do that.
I watched
So
The
now you
Sopranos
just
like
now you
3
just fast
times.
forward to the good parts?
Oh, I don't even bother to do that. Yeah, like I've just given up on that. I just watch hockey now.
You still enjoy hockey, eh?
What kind of a question
I
is
don't know.
that?
I just hit this
I have
point
not
where
watched a
I
hockey
couldn't
game in
enjoy it
forever.
anymore. I just
Yeah.
I hit this point where too
I
much
don't.
hockey.
I think I like the interaction socially. Listen, it's like one of those things you can run in the background when you're shooting the shit with people, and you don't have to pay attention. Because like when you watch a TV show or a movie, you got to watch the plot. You got to listen to all the different things. You have to like sit there and focus. Hockey is one of these things where
You can get drunk and you don't have to worry about
yeah,
it.
no. You can have a couple beers and have a conversation with someone, and oh, look, they scored, and then you watch the replay. Like you can socially watch the sport and not have to sit there and dedicate 2-3 hours of your entire attention. It's more like a distraction and to create a little bit of an environment, right? That's why one of the fun places to watch sports is in bars, right? Like it's running in the on the TV there, but you're socializing and drinking beers and having fun. That's why I still think sports are a lot of fun to keep in there. I'm not one of the hardcore guys that sits there and just stares at a game minute by minute. That's crazy for me.
Because you don't have 10 large on the game.
Well, that's dedication then.
It's like that. You ever see Dave Portnoy? He like tosses around like 10s and 20s on each game.
No, listen.
That's what he does for a living. I think he's kind of almost a professional sports gambler, though.
Yeah, well, he was a professional stock trader earlier too.
He's pretty good at it. Does he stop stock trading?
I have no idea. I'm sure once you've tasted this trading nectar, it's hard to go away from it ever. It's like whether you make money or lose money. Once you've wet your whistle, it's hard to ever walk away from it entirely.
So now, have we spoken since you got back from the moose hunting?
Yeah.
Yeah, last 2 weeks ago.
Yeah, we did.
we? Okay.
Yeah.
All the
Okay,
moose
I'm
meat.
looking forward to my moose steak.
Dude, it's ready to go. We've
Have you
had
been eating nothing but moose steak?
I just over the weekend made a kick-ass Eastern European moose goulash. It was awesome, buddy.
Moose goulash.
Yeah, I fed the Rum Shack boys.
And how about you, Lena? Are you recovering? Everything good?
Everything is good. Wedding went well. Luke showed up on time.
That's
Oh,
good. That's
wow.
always a good thing when he
so
shows
that
up.
was that
Yeah,
was a big
I
bonus.
was. I
Patrick was on his
I
best
witnessed
behavior?
it, and up until no, just kidding.
Up until
Well, let's just say we had to send him home in an Uber.
Well, you know what was funny though, is that they went and they booked a room at Harbor 60 for the dinner, and well, it was a phenomenal dinner. But like they ordered redonkulous amount of apps right off the bat. Like they're bringing these huge seafood trays and all this shit, like plopping it down on the center of the table. Then when it comes out and they bring me my ribeye steak, I literally packed the ribeye steak
Get
to
it to
go.
go, please.
I did not even have room for a frickin' bite of this thing.
you were like your teenage kids when you tell them not to eat too many appetizers because they won't
yeah.
really eat their
Oh
full.
man, the
full-
lobster tails and all this shit. Like I'm just like chowing down everything and anything and everything, and it's like, and suddenly the steak comes out. Nope, no room. No room. I did eat it the other day, and it was delicious.
Yeah, we had some leftovers, so that was good. It was a meal that kept on giving.
Lena was very dedicated though. Like I could tell when I sent her the file when she went back to work, and I was like, I saw it Monday morning, like first thing, your file has been downloaded, and I was like, what's that about?
Oh,
Lena,
Back to
I was like,
business.
you're like a hardworking person. You didn't even take a single day off almost.
Well, what am I gonna do, right? Like it's not like we're going on a honeymoon.
Are you going? So are you going to go eventually?
Well, we kind of went and we did everything kind of backwards. So we went to Europe in summer, and then we're getting married. We got married, and then we may, plan another trip, but that won't be for another, few months. So we're doing kind of everything backwards.
they did Paris for their little pre-honeymoon.
I don't know what kind of accent that was, but yes, we went to
That
Paris.
was kind of weird.
That was
For those who don't know what he said, it was Paris.
Betty.
Oh, that was your attempt at French.
That was my horrible attempt
Oh
at
my
French.
gosh. We're going to get
I won't even try. I'm just gonna stop. I'm just shut up. You guys continue the conversation without me. I'm just gonna stop
Well,
talking
anyways.
right now.
Anyways, Lena, you were quite admirable how you went right back to work. So I was very impressed.
Thank you. That's how I like to roll. So
I'll tell you. So we should let Patrick get off to his hockey game.
yeah, 'cause
Yeah.
he's pre-drinking it with us right now, and then he's gonna get properly sloshed when he's at.
Oh,
the
I
game.
don't think so. I think I'm just gonna have a few there. I mean, at what $20?
I was going to say he's too cheap to buy at the Cineplex. If he's too cheap to buy at the Cineplex, he's definitely not buying at the Rogers Center or whatever.
I'll be
it is.
sipping.
It'd be
I'll
like
be sipping.
$20 a pint or whatever it is.
What are they like?
Yeah, $20 a pint. Like it might be more than a pint. It's like those large beers, but
So I
still.
have a question. What is it when you go downtown and like you're at a bar in Toronto and you order a beer? It's been a while for me. Like, what is per beer now?
I have
Well,
no
I've-
idea.
No, like you should, like no, it's usually it's under 10 Canadian, which is
It's like $8 usually, isn't it? Like $7 to $8.
Yeah, so,
No, it's more
yeah.
than that.
No,
Okay.
well, no,
Really?
like listen, every place is different. Like
No, I
you
know,
go
but
the
like a
higher
decent
end
place.
places. Oh, like a decent. No, I'm just talking
Decent
about
place, probably
the
10 to
I'm
12.
talking about the
$10.
local bars. No, I'm just talking local bars
I know,
that I
but
go
like I
to.
mean, like if you're at
are
Jack
under
or something
10.
like that.
They're under 10.
You
Canadian.
think?
They are. I'm telling you. I've been going.
I'm looking because I don't
He's been
believe you.
going.
Are you going to tell me I've been paying more than I have?
No,
Like, I mean-
here the cocktails are 15 at Jump. What's a beer?
Probably like $10 to $12,
Oh,
depending on what
$8.50,
kind of
10.
or what
$8.50,
kind of
10.
beer it is. If it's
Yeah,
import or
8 to
not.
10
Okay.
bucks.
Yeah.
That's a pretty
So
standard.
that actually hasn't gone
but
up
it's
that
what's
much.
it's quite amazing is actually the cost of beer in Europe. What's interesting. Okay, it's like you go to like somewhere like Czech Republic. Well, I was in Prague for a weekend, and I got like literally 5 pints. Like a flight of 4 pints a flight to try these different 4 pints. Oh no, they were like 30 CLs, right? So they were, and it cost €5 for all of them. You then go like somewhere like Paris, and one beer is gonna cost you like 20 fucking euro. Like it's like just like going from one country to another in Europe. Even though it's open borders and all this shit, like the price difference in beers from one country to the next in Europe is insane. Just the volatility, like it's. Well, no, it's not volatility. It's not
I
volatility.
was so like as I traveled along, I wasn't sure.
I think there's a way to arb this out. Like we should like just fill up trailers of like Czech beer and deliver it everywhere else in Europe.
So I have a buddy that just got back from Portugal. He told me it was dirt cheap there.
Oh, Portugal.
That's why all the English go there.
Oh, beautiful. It was.
Is it dirt cheap?
Well, I mean, look, I wouldn't call it dirt cheap, but it's very well priced. Like you can actually have a great time at a very reasonable price, and it's just a beautiful country.
Yeah.
Beautiful city in Lisbon. I loved every minute of it. I'd go back in a heartbeat.
Okay, well there you go.
Yeah.
Okay,
All right, let's wrap.
Go Leafs, go!
Go Leafs,
Have a great thing. Congratulations again, Lena.
Thank you.
Yeah.
And we'll see you guys next week.
All right. Thanks, everyone. Cheers.